I think we can start, right? So good afternoon, everyone. My name is Fabrice Riva. I am a professor of finance at Université Paris Dauphine, PSL. And I have the pleasure of coordinate this afternoon session of the Dauphine Digital Days event, the one which is dedicated to AI and finance. So the session will be organized in 3 parts. First, from 2 p.m. to 3 p.m., there will be a roundtable moderated by my colleague Serge Darolles, who is also a professor of finance at Dauphine. And it will bring together 4 experts who will share their perspectives on the transformations brought about by AI, particularly generative AI, in the world of finance. Second, from 3 to 4 p.m., we will have 2 research paper presentations, one by my colleague, Vincent, who is an assistant professor in the finance research team, and one by myself. And finally, so next we will have a coffee break, a 20-minute coffee break. And finally, from 4:30 to 5:30 p.m., we will welcome Semyon Malamud, a professor at EPFL, for a keynote address. So it's time now for me to hand over to the roundtable. I wish you an excellent time with us. Thank you.
So thank you very much, Fabrice, for this introduction. So my job, I'm Serge Darolles, I'm professor of finance at Paris Dauphine, and my job today will be to moderate this panel session. So more or less, I have to keep time, and that will be my job for this session. So I have 4 speakers, distinguished speakers for this session. And this session will be organized in 2 parts. First, use cases, because it's very important, I think, to have real feedback from this industry. And the second part of this panel session will be about the benefits and limitations of Gen AI. So we'll start with the first speaker on the list, Tom. So you're coming from IFC, and you're director of Treasury, Capital Markets, and Investments. And I let you the floor for 10 to 12 minutes.
Thanks, Serge, for having me. So I'll just click and I'll have my presentation. Okay. Good afternoon. As Serge says, I'm Tom Ceusters, the director at IFC. For those who don't know, that stands for International Finance Corporation. We are one of the 5 operating entities of the World Bank, having the same mission, all of us together, but we operate in the private sector. We run our separate balance sheet, and so I'm in charge of everything that is issuing the debt, and then also the liquid asset portfolio to manage our liquidity such that we keep our AAA. But I'm going to focus, probably the most simple and straightforward case, I'm going to focus on the debt issuance. Balance sheet is about $115 billion, and we have about $65 billion of debt outstanding. We are a premier issuer, or AAA. We sell our bonds all over the world to finance our activity, which is lending through the private sector in emerging markets. So we are a standalone entity with a sustainable goal of making money in the long term and not going back to our shareholders for additional capital to replenish our capital base. And why I'm saying that? Because our cost of funding, what we call our cost of funding, the level at which we issue our debt is very important, and that's the case what I want to focus on. So, as you're all in the university, I'm sure Serge and Fabrice tell you what determines price. The students, my students know that. What determines price? Supply and demand. I've been 35 years in the market, supply and demand, remember that. I know what my supply is, $15 billion a year. I'm in the market, issuing debt, selling bonds, 3-5-year bonds, I'm selling those. So what can I do to improve my price as an issuer? Create more demand. And this is where this case comes in. We issue in about 35 currencies. As I said, we're a relatively sophisticated issuer, but half of our issuance is still in the United States. 45 to 50% of all wealth globally is in the United States, so that's where I'm going to sell my bonds. And one particular subset of buyers in the United States are state and local municipalities. As you know, California would be the 6th largest economy in its own. Some of these counties, LA County, has a GDP that's bigger than most of the developed countries. Those are $500–600 billion economies on its own, these counties. So they manage their own finances. They have a treasury, which is very sophisticated. So that's where I'm looking for to sell my bonds. 50 states, as you know, 3,000 counties. And the beautiful thing is, from a transparency perspective, is that they have their investment guidelines public. They, on their website, they need to publish what their guidelines are and what their holdings are. So just to put this in perspective, I have some numbers. We do already talk to a big part of our investment base is already these state and local, 1.3 billion out of the total 15 billion that we do every year. Those are very stable investors. If some people know about regulation, net stable funding ratio, you subdivide your investors based on the stickiness. So someone that is likely to come back going forward has a higher value than a hedge fund that, you know, on a whim of time, it might change his mind and go somewhere else. So these are very stable investors. It's estimated that they manage collectively $3.4 trillion. If you just take the rule of thumb that they can only invest 5% max in one issuer, I'm chasing $172 billion, which is quite interesting. So that's the use case. If I can read all of their investment guidelines, I have a much more targeted, what we call investor relations effort. I have a team of 8 to 9 people doing the funding. We work with dealers like JP Morgan, BNP, SocGen, you name it. But we do a lot of direct outreach to investors ourselves. So that's 2–3 people. If you can really target who you're going to see, it's a much more efficient effort. And that's where AI comes in. If we could read all these policies and know whether we are eligible or might be eligible as a potential investment for these treasuries. So that's really the use case that we try to establish, where they're eligible. And then also, if they have never bought IFC, did they buy some of our peers? Because the World Bank is a better name. We have, unfortunately, but that's another reason, International Finance Corporation. We're not really a corporation, but people look at us as a corporate. So we just need to tell our story. So that's the use case. And I'll come back on this. This is probably the better slide. As I said, it's relatively easy to implement. We go on each of these websites and gather the links of the documents. And the power of AI is the fact that these documents are not uniform. Some states will have their investment guidelines in plain text. Some other ones will have nice tables. They will spell out our name. They will say IFC, or any member of the World Bank Group, or a supranational based in DC, Washington, or a AAA institution. We are AAA, so we fall under eligible investments being AAA. So it's not straightforward to read the documents and to determine whether we are eligible or not. But so gathering the information, some of those documents are really nice documents, PDFs. Some of them are scans of signed documents, you know, only grayed out. So you first need to convert them to text. So that's what we did. Put them all in the database. Used our own version of ChatGPT. You know, we call it Chat IFC, but it's OpenAI version just on a different server so that none of the information is public that we put on it. And then I think the force, the strength of it is that we can put it in structured format. Are we eligible or not? Yes or no, Boolean. What is the limit? 5%, 10%. So these answers come back as structured information out of a really unstructured set of documents. We are reading about 22,000 pages now. So every time it's actually, when Serge asked about resources, it's an undergrad student that does an internship with us. She's just looking for these investment guidelines. Every time she adds one, the number of pages goes up by 40 pages. So we're at 22,000 pages right now that we're reading, and on the dot we have our information. And then it's about prompting. That is something that took us a while. Learn how to prompt. I think if you talk about AI, you'll see that comes back as a recurring theme. You asking the right questions is really important. So that took us a while, but once we figured it out, it went fairly quick. The difference between version 3.5 and 4 was tremendous in terms of output, and then obviously you need to do some reality check, but every time you get the answer, you also get the reference where exactly the answer is in that particular investment guideline. So that was an iterative process, asking the questions. And from a risk management perspective later on, this is very, very powerful. That is information we would never, ever have. We went through we went through an evolution of a conversations with our shareholders, asking the question, do you really need to be AAA? And we always said, yeah, it's really important. But we never had any empirical evidence. Now I can show, with this tool, I know exactly who has the strict requirement that we are AAA. And so I can determine my investment public or group of investors before and after whether I would be downgraded from AAA to AA, for example. So from a risk management perspective, it gives you very powerful tools to do a scenario analysis. So from us, managing our liquidity, this is very important. So that's just a set of questions that we used. What's the minimum tenor? What's the maximum tenor? What's the maximum percentage that they can buy? So you determine really per investor, what is your potential? We never hit that, but it's always nice to know about that. So, and then just to show you what people don't always realize, it's a contextual setting that is really powerful. In this particular question, for the state of Virginia, are we eligible investor? And the short answer is no. But the engine also came back with a long answer. Well, you're not eligible, but it will be nice to know that your sister company, in this case, International Bank for Reconstruction and Development, which is the original World Bank founded in 1945, they are eligible. So for me, that's really powerful information to know that an institution very similar like us is already eligible. So all we need to do is approach them and say, listen, if you invest in us, we're the same thing. But that context, it's not that we taught the engine that we are a sister company. The engine knows this. So that is really powerful from a reference to see, you know, it not only says yes or no, but it also gives you context and helpful information on top of that. And I think that's mostly, I have other examples, as I talked about scenario analysis, what is the impact of our rating on whether we are eligible or not. So for us, that's really powerful information, and that is something that can never be replicated by human beings. And there's no way people can start reading 22,000 pages or whatever all at once or very efficiently. And then we build our own interface, a dashboard, all at our fingertips, where we have all that information, the source data documents, the structured data, as I said, just as I say, see on the right, are we eligible? Are other supranationals eligible or not? So that's really the useful tool that we build around it. And I think, Serge, I will stop here. We do have the little demo, but that's the prompting. As I said, you can ask them whatever questions, and then it will come back with the answer. If you get downgraded, what would happen? It will tell you that the investor, this particular investor, has 30 days to liquidate your bonds. That's really, for us, for someone who manages a balance sheet, that's really important information. So that's really powerful. I think I'm going to stop here, Serge.
Thank you very much, Tom. So we have three other use cases to present. So I let Emmanuel continue the presentation. Emmanuel is the CIO of RAM AI and head of systematic equities.
Hi, everyone. So maybe a few words on the way we use AI. So we are an investment manager based in Geneva. So we have in the last 10 years, I would say, embraced deep learning in our processes. We've been pioneers in investing in emerging markets with a quant process. And so the idea today is to give you an idea of the benefit of large language models in terms of adding more information to our process, in terms of making better stock selection. We run strategies in Europe and emerging markets, mostly. We have thousands of stocks to follow every day. And we find that language models, so large language models, are an extremely useful tool to enhance the data we have on the companies. If we wanted to follow the news flow on these thousands of stocks daily, we would need hundreds of analysts reading the news, predicting the impact of the news on the stocks. And so today we finally have a strong quantitative tool to do that. So we have large language models. These models get close to human level in terms of interpreting text, in terms of analyzing text. They've been trained with huge corpuses of data. And being able to integrate that in our process is a real game changer. We do believe that language models are likely to be integrated in most of our workflows in asset management. But in this integration of news, I think it's a good use case. The real revolution of the last few years is the development of smaller models, these lightweight language models, which give us the capability of having unique models. So instead of using state-of-the-art models through OpenAI or other platforms or Claude, it's beautiful to see that we have small models that are very close to state-of-the-art in terms of competency, in terms of capabilities. But these models we can use on our own servers in terms of inference, so using them for text tasks. But we can also train them and fine-tune them on our own servers to make them experts at extracting information useful to us from news, from the transcripts of earnings announcements and the Q&A sessions with analysts. So it's a real game changer for us as quant investors, because it helps us to have our own proprietary models that really no one has access to. These models are trained with our own data. So news we have on this EM, on these European companies, and with our own objective. So our objective is to predict returns on the back of this news, so in the next weeks. And so we fine-tune and customize these models to our own aim. So it's great because it helps us to integrate new information in our process. We can now integrate news before and integrate this information before analysts revise often the revenue estimates for the stock or the earnings estimates for the stock. So it helps us to get information on events on the company earlier than what we used to have before. We use these text-based inputs, thanks to large language models, next to hundreds of other inputs. We have fundamentals, we have price, technicals, liquidity information on the stocks, and then use deep learning to combine all this together. So language models to me are a big game changer for quant investors, helping us integrate new data sets. It's also the case for discretionary investors. We have at RAM also discretionary teams on the fixed income side, so managing credit funds. We have a credit picking team. The interesting thing is we think so these language models can be useful for these guys too. We have in recent months done a lot of work to see if these large language models were capable of doing financial analysis well. What we find is that we are in a situation where we can now feed statements, so financial statements, to these language models and get with OpenAI type models or with lightweight, so open source models, strong inputs, so strong outputs by these models. So we started helping our credit team get financial analysis done by large language models. These large language models do the job of a junior financial analyst, and it helps them have hundreds of credits covered. And it's as if they had junior financial analysts doing the job, but it's a large language model basically analyzing the statements, giving a credit rating. So there's been a lot of prompting work there. So this agentic AI needs, so you need a lot of work to get the model to do what you want it to do. But once you prompt well the language model, you can actually get very decent results in terms of financial analysis. There was a good paper by University of Chicago on doing the same for earnings prediction a few months ago. They found that LLMs, so it was GPT-4 there, outperformed the consensus of analyst estimates on financial analysis, feeding income and balance sheet statements to GPT-4. So it does open the door to having AI agents which basically do a lot of the process of treating data, managing data, and giving us relevant outputs. Obviously, we believe there's still strong value added in our experience, and there's a strong value added in getting the model to do what you want it to do and using the information well. But it's a great way to streamline workflows and to do things more efficiently. I hope it helps us on the investment side to focus on more creative, more value-adding part of the process, and help enhance the process.
Thank you very much, Emmanuel. So our next user of AI is Alex Marandon. Alex, you are the global head of Invent Gen AI Accelerator. So what is your example?
Well, first of all, thank you very much for having me. Super excited to be here to share a bit of the Gen AI love. First and foremost, maybe a question about how we took the Gen AI approach at Capgemini. Of course, Capgemini is a very large tech company. And we saw in the early days of 2023, Gen AI as an existential threat. We have 150,000 software engineers in India. And the question was, how do we make them, how do we augment them with the use of Gen AI? And so that was a critical productivity question for us to change all our internal processes to make sure that we integrate Gen AI in the way throughout the software development lifecycle so that we can give some of the value back to our clients. And value is actually the key word here. value is something that we're looking to implement at our client and to help our client unlock and leverage, simply because today most of our clients are sitting in the POC Dev Valley and they have implemented scores of different use cases and they don't know what to do with them. They don't know how to scale them. They don't know how to extract value. And so the challenge is really to help them scale and to help them extract the value by embedding them into the processes. And of course, we're looking at GenAI from a prompting perspective. We're teaching the art of prompting, both internally but also for our clients. We manage change using GenAI. You've all seen, I'm sure you're all using ChatGPT for your homework. It requires effort, it requires adoption, it requires a change on how you work. And that's the same for our employees and for our clients. So that's something that we're putting a lot of effort on. And of course, you mentioned IFC GPT. We have all the insert your company name GPT type of implementation that we do with our clients. And if we zoom in on the financial sector, couple of things. First of all, there is a strong history of legacy code that no one wants to teach, no one wants to learn. COBOL, Fortran, mainframes, typically, this is the perfect tech to translate this code into something which is a bit more sexy. And we can, of course, automate all of these code translation processes, and we're doing a lot of that, and the financial sector is very strong in that domain. Everything which is text and voice intensive, text on the document, contractual, supply analysis, everything which requires the analysis of hundreds of pages of documentation, of regulation. This is something that we're looking into quite heavily. On the voice call center, you've all heard about some of the news with Klarna deciding to lay off all their call center. I think it's kind of a pipe dream, and of course we will still need to some extent these functions, but for sure they can be heavily automated through GenAI. So that's something we're looking into. And last but not least, everything related to analysis, data analysis, data generation. It's a core use case for our clients to be able to unlock some of value.
Thank you very much, Alex. Last speaker in this part of our roundtable is Christophe Morel, your senior economist at Groupama Asset Management.
Hi, everybody, and thank you a lot for this invitation. The day-to-day of an economist, and more generally, the day-to-day of any analyst working in the finance industry is deeply transformed by AI. For instance, in a very recent academic publication, Anton Korinek showed how ChatGPT can improve the daily task of an economist for doing, for instance, its bibliography, for writing, for coding, and even for modeling. So the productivity gain for existing tasks is obvious. But AI becomes more interesting for new tasks. What are those new tasks? There is clearly an explosion of the volume of information, particularly data text information, speeches, videos, publications. For instance, over years, central bankers have significantly increased the frequency of their communications. Before the great financial crisis, monetary policy statements were short, very short, 3 lines. And central bankers were not used to speak frequently. Now, they speak all the day, at the breakfast time, at lunchtime, at tea time, at every time. So clearly, it's impossible for me to read everything. Impossible. But I need to do this because I'm supposed to infer what they are doing to do. So I need tools who are able to read at my place how I used to read the text. So I say the volume of information is exploding. Some information is relevant, some are not relevant. A lot of information is noise. According to us, two kinds of information are very interesting. Information coming from corporate speeches are very relevant because corporate are influencing directly the economic cycle. So this is very interesting. And then central bank speeches, because they are setting monetary policy, they are setting interest rate level. So those two kinds of speeches are very interesting. So at Groupama Asset Management, we have developed two kinds of, let's say, indicators. Business sentiment indicators, because you probably know that we have business surveys, and in those business surveys, you have some comments from corporate. And so we have transformed those comments in quantitative indicators to have valuable information. And we have shown that those comments are increasing information to forecast growth. And sometimes it leads the information coming from survey the next month. And currently, this is very interesting because you probably know that surveys are very weak, and we are seeing some early signals from the comments that the business cycle might be improving. Second kind of indicator, central bank sentiment analysis. So we produce sentiment indicators based on central banks' speeches on different topics, growth, inflation, monetary policy. And we have also developed indicators that measure the degree of consensus between central bankers. And so this is very interesting because currently the consensus is very low. So it means that the equilibrium is very unstable and it might change very quickly. And all the more we see some upturn signals from their outlook on growth, signaling that a pause in the in cuts in interest rates is coming. So let's say to make a long story short, I would say AA is currently very important in our day-to-day as an analyst.
Thank you very much, Christophe. So we can go now to the second part of this roundtable, and then to organize this second part, I have a first question, and I can ask this question to Alex. Is the cost of infrastructure is a major barrier to GenAI adoption, or do you think you have different barriers?
So, great question, because we've all heard about the cost of tuning, training a model, which can range up to tens of millions of dollars. I don't think that's the main issue here, because with now the widespread of smaller models, of models on the edge, it's less and less becoming a concern. However, the cost of adoption, the cost of implementing into the organization, embedding this tech into existing processes to automate them, and the opportunity cost of not doing so is becoming increasingly important. That plus the cost of adoption, managing not only the fear of people who might see their job being displaced. I had a very interesting discussion with a copywriter a couple of months back who was fearing for his job, and I was telling him, well, look, what is your productivity gain through GenAI? And he told me approximately 30%. Well, you should be afraid had it been 80 or 90%. But now it's a productivity bump of 30%. The question is, what are you going to do with it? But in a nutshell, we have to train and we have to accompany employees, people into the implementation and the usage of that technology. And not doing so might incur a significant cost.
So, any other comments on this part?
Maybe to come back on the cost of infrastructure, it's true. So the lightweight models development is fascinating. So just to think that a model like Llama 3.1, so with 8 billion parameters, so 50 times smaller than GPT 3.5, is as good as GPT 3.5 was or is. So you diminish the size needed to have these very strong models by 50 within 2 years. It leads to many more companies having the access to this technology, the access and the capability to train these models for their own needs, for their own tasks. And it reduces the cost of infrastructure needed by pretty much 50. In the meanwhile, it's been very interesting because the research on how to fine-tune models, fine-tuning is basically specializing the model that is already trained on huge data sets to a specific task or a specific data set. What we have seen is that you have very efficient methods of training, of fine-tuning models. You only need to fine-tune or train or a fraction of the model parameters to adapt the model to a new task. This more efficient training, this more efficient process of adapting models to a new target, to a new task, means you need less infrastructure, less GPU cost to adapt the models. And so all this trend is leading to less investments needed, more democratization of AI across the board.
So you're an asset manager, so if I understand well, you can still compete with BlackRock, even with AI?
So we believe we can compete with BlackRock. So as I said earlier, so even more on emerging markets where you don't need trillions, so billions of data sets to perform. So we can compete. We have our own GPU infrastructure. What we do in fine-tuning large language models in our company, I think, is comparable to what many larger firms do. Because you don't need millions of investments in terms of GPU servers to have the capability of adapting these models and training these models for given tasks. I do think that smaller players actually are very agile, typically more agile in integrating new technology. We've seen that with OpenAI, which was ahead, with a few people at the start, ahead of the major tech players within a couple of years. So I think, it's possible to embrace that technology for small players. The research, the technology in the last 2 years is going in that direction to more democratization with these open source models. And I think it's a very welcome development. Yeah.
Yeah.
No, on our side, there are two things. That is the cost and as the title says, the benefits. But in terms of cost, and we talked about that during lunch, an organization like the World Bank is obviously a very huge organization, semi-governmental. So we're heavily bureaucratic. Any IT project will usually take a year, 2 years, if not longer. But at the same time, you try to be very agile. So we do have a setup where we have a sandbox approach, completely isolated just for our purposes, completely off the wall, behind the wall, whatever you call it. And then it was then very straightforward. It was just me and someone in the investor relations coming up with the problem and the business case. One developer that is able to understand the technology, write the Python code, and someone in the IT department giving us the resources, the sandbox, the data server, the access to the APIs and whatnot, and all of that. What you saw there took us 2.5 months. So that was, but the cost, I don't know, I didn't put a number on it, but the gains are, in my case, very tangible. I talked about, supply and demand. My demand, we identified 45 counties that have us approved, that have IFC as eligible investment. We compare that data with our Salesforce database where we know who invests in our bonds. 45 never invested in our bonds, but they have us approved. So that's gold. And I can put a number on it in terms of benefit. 2 years ago, when we did our $2 billion benchmark, every year we issue a 5-year bond, $2 billion. We go to the market, we hire 4 or 5 big dealers, and technical term, initial price talk, they give us a level, this is where you need to issue your bonds. And we feel more comfortable saying, well, I think we can shave off a basis points and start this process there. 1 basis point for a 5-year, $2 billion issuance, net present value is more than $1 million. That's an easy calculus for me. The fact that I can start my discussion with the market 1 basis point lower than I would be doing without my own information, that's, as I said, that is real income and with real benefits from my perspective. So then the cost doesn't really matter.
Yeah. Thank you very much. I propose to switch to the second issue about data. So models are, of course, important for AI, but they must be fed with data. And I wanted to ask you, Emmanuel, how important is the choice of data in this learning process?
So I must say that, so generally with machine learning, you need to do a lot of work in terms of pre-processing the data, so it's key. We do a massive amount of work in extracting information from noise at data level on a lot of the inputs we construct. So it's very key for us to get tangible results because deep learning, so the less noise you have in the data, obviously the more information to noise ratio in the data, the better the model will be able to capture the patterns and combine your inputs together. So we still do a massive amount there, and our own experience is very helpful in terms of managing the financial statements information, the price information on the companies still. So that being said, what is very interesting is when we have predictions of returns done by your models, we can analyze what inputs contributed to this prediction. So it's very interesting to look at the biases taken by the models, so by these deep learning models. What we wish as investors is for the model basically to take the same biases we would take in terms of fundamentals, valuations, so having a value bias, having a low risk bias, having quality biases that we tend to have as investors, but doing that with a much higher dimension than we do as humans. So when we built quant strategies 15 years ago, we used 10 to 20 different inputs, so crossing fundamentals inputs with price, liquidity to build a strategy. Now, thanks to deep learning, we mix 500 alpha inputs together, coming from the text data I referred earlier, coming from price, liquidity time series, coming from fundamentals, analysis estimates, positioning data by the market, to derive our return prediction. So it's doing the same job, so our hope is doing the same job that we used to do, but with much higher dimensionality. On the data sets, I think that any financial firm would have their own data set, so their own proprietary data, which typically has value, so carries value, so it's the reflect of the work they've done in the last years. And to come back to the lightweight language models, having these lightweight models that you can train on smaller infrastructure is great in terms of getting value out of your data, getting value out of your data sets. So as financial companies, I think we all have now a much easier way to do it. The language models are actually great at that. And I think so you will have many more models now basically customized to your data needs. So this news flow model I was referring to earlier, we have on the side earnings announcement transcripts models. We have other models analyzing charts. So each company will be able to build their own proprietary models on the text side, on the chart side, so vision side, that best suit their needs, right? So the democratization of language models with the lightweight language models should bring this democratization of AI integration, of proprietary model development by companies in the next years. Yeah.
No, just to build upon that, well, the obvious answer is, of course, very important. That's quite obvious, and we're kind of in a garbage in, garbage out type of approach. So the higher the quality, the higher the output of the model. But what I'd like to touch upon is the notion of bias. I've seen and I've read a lot of topic around how do you unbias, how do you debias your model. And to some extent, all the data set carry bias. Just to give you some figures, 95% of all training data for these large language models like ChatGPT comes from the US. I'm not even English. They come from the US. And the remaining 5% is a mix of English and 3% all the other languages. So you can very well imagine the level of bias that these models carry. And it's okay, because as human beings, we also carry bias. We carry bias based on our education, based on our social setting, based on the country we live in, etc., etc. So we need to be aware of them, and we need to be able to understand and to put in place the proper guardrails in order to get the model to do what we want. And also to be very aware of what is the cost of a biased response. What is the cost of these models failing? And these models will fail to some degree. But we need to be aware of, is it acceptable for the model to fail? Under which circumstance? And at which frequency, and what is going to be the impact? Is it some hate speech to your customers, a reputational risk, or is it a security clearance at the airport where you have models tweaked towards a false positive, because it's better to do a double check on someone rather than letting go a knife or weapon through the system. And that's something that we need to be aware of, and the solutions have to be designed according to the potential cost of failure.
So thank you very much, Alex. It's time to go to the last theme of this part of the roundtable. So up to now, we talk about model and data, but human resources are also important. So Christophe, as a member of the education board of the Master Finance of Paris Dauphine, what is your advice to adapt our program to Gen AI revolution?
So first, we must recognize that AI is a very powerful to learn. It's amazing if you want to integrate some knowledges, and probably even if you want to revise very efficiently before an exam. So it is crucial to help students understanding what LLM can do. For instance, I provided examples of how it helps me in my day-to-day to forecast economy. And I think that more broadly, LLM can reveal expectations, which is absolutely essential for valuing financial assets. So LLM might be a great tool to infer expectations from embedded prices. But I think that also teacher might highlight what AI cannot do or do very poorly. So you mentioned bias. It's true. I have the same experience. In a working paper, I showed that when classifying central bank speeches, there was a dovish bias. And it's usual because probably the LLM was trained on dovish economic conditions. So at the end of the day, you have a dovish signal, which was false. But remember that in LLM, sometimes you infer beliefs, and belief is not true. And you need sometimes, particularly when you work in the finance industry, to be out of the box, to be, okay, to take those beliefs, okay? That's very important. So I think AA is a great tool for educational. And I think that AA will never replace long experience of teachers. So that's very important. And above all, that long experience of mistakes. We have done mistakes, and those experience of mistake is probably the most valuable thing we can teach to our students if we want to not fail where we have failed.
Thank you. Any other advice for us?
Maybe a quick comment on that. There is no closing the Pandora box, I would say. You know, the tech is there. We have to somehow make do with the fact that it's widespread, it's available to everyone. And so the question is, rather than forbidding it, how do we promote it by teaching how to use it, which I'm sure you already do, and maybe bashing open door here, but I think it's very important, and I see the importance of mastering this skill in an enterprise, in companies, in the corporate world. The younger you start, the earlier you start by harnessing this tech, and maybe our children will learn to use them quite efficiently. The question is, what will we teach them with this as a tool available to them on a day-to-day basis? How do we promote critical thinking? How do we promote the exercise of judgment? I think these are the core skills which will remain as part of our intrinsic human being, and the ability to exercise our judgment. And that's, I think, the most important.
Thank you very much, Alex. Any other comment from the panel? No, so we have a few minutes for the Q&A sessions. Is any question about the topic? Yes, please.
Oh, yeah.
Hi everyone, I'm very happy to be here and to participate to this conference about AI in finance. It's true that finance is not very my thing, but anyway, I'm very interested by AI, and I think I can learn a lot that it's already done, because I think what you say and what you exchange between both of between you and the other speakers is very interesting, and enrich the conversation about AI in finance. So what can I say about AI in finance? I think AI, to see a larger view about AI, it can really help, and it can accompany in many industries and in many sectors. AI can be like a best friend for everyone, because he gives service and he don't ask anything in return. He's very helpful, and and if it is trained with the right information, it can convey a very good message, and it can as well advance conversation. No, it can advance the thinking and the process thinking about the general reflection is the word I was looking for about many sectors and topics, but we have to orient it because AI is just a tool. We need to give him the right information and the right advice for him to provide what we need from him. That's it.
Maybe just a few words on that. So it's true that many workflows can be significantly improved with AI. One of them we didn't mention too much is coding. So it's true that programming gets at least 40% faster with an AI. When you want to code something in a domain you don't know well, it's particularly helpful, to have an idea of the right technology to use. So I think it's a lot of our workflows, a lot of the repetitive tasks that can indeed be automated to some extent thanks to these models, which can be a huge productivity gain in companies.
Hello. My name is Tolkien Garduño. I'm a PhD student at the Université Technologie 3. And well, my question is directed towards what was mentioned about the bias of the models, because I mean, right now it's true that we have a whole set of benchmarks that come along with specific metrics and tasks, and you have a lot of you have zero-shot models, you have different models that can be fine-tuned or adapted to specific tasks, but still the problem remains. The problem of bias. So you cannot really extend all these models, and even though they are like small and easy to pack models, you still have to use an API to communicate with the large company models that are not freely available. My question is then, do you have any specific set of tasks in which you have found that small models being trained from scratch are able to outperform these big models?
On interpretability, on our side, we do a lot of work on interpretability, on interpreting what the model does. It's key for us as quant investors. It's key to have inputs you can understand. So as I said earlier, for each prediction we do, for each company we look at, we can tell how much of that prediction comes from the valuation of the firm, how much comes from the price dynamic of the company, how much comes from insiders buying the stock aggressively. And so you have now actually a good way to ensure you understand the biases taken by the models when you train these deep learning models. Which means you can also control the biases you take to some extent. Actually, we tweak sometimes to see, to test what it gives. If we find that sometimes the deep learning models don't take the bias we wish, we constrain that bias and don't necessarily find always worse outcomes. So you can actually bias the model to what you wish. So for us as investors, it's quality, it's key. For the lightweight models, so yes, today you have strong lightweight models that where you don't need to use the OpenAI API to access. You can keep all the data, with you. So you don't need to share the IP, you don't need to share the data with OpenAI thanks to these lightweight models. So this is what we do at RAMS. We want to keep full IP of our data, of our inputs. And these models, when you look at benchmarks, today, as I said, so the small models are similar in terms of performance to GPT 3.5. Some more recent models are even better. So you are close to the state of the art of 2 years ago, which for a lot of tasks is already great. So I have no doubt that within 1 year, you have models as good as GPT-4. So actually, some smaller models are very close to the model fine-tuned by NVIDIA on the Llama 70 billion model is as strong as GPT-4 on many tasks. And this is a model you can have potentially use on mid-sized GPU infrastructure. So again, you don't need to be Microsoft to do inference with these models. So the democratization is taking place definitely. And yeah, I'm very sure. So given the recent dynamic, I'm very sure that within 12, 18 months, it'll be even more accessible to everyone. Yeah.
Okay, so I think we are out of time. So we can thank all the speaker and the audience, and I'll let Fabrice take the floor.
Okay, so that's now the second part of the session. So there will be, as I said, 2 article presentations. The first one by my colleague Vincent TENA, and I will present after.
So hello everybody, I'm Vincent TENA, and I'm very pleased to present my joint work today with Gilles Chemla. It was a joint appointment here in Dauphine and also in Imperial College in London. So thanks again, Fabrice, for organizing this very nice afternoon of discussion about AI and finance. So this work will be discussing about AI adoption, incentives, and market outcomes. So a little bit of motivation that is quite straightforward. Why studying AI and finance? Well, there are so many empirical evidence that AI adoption is spreading fast in the economy. And this is not anywhere. It's particularly true in firms with high market powers, so in top firms, if you would like to say. And it's also accompanied with many great benefits. So we have AI investing firms that experience higher growth in sales, employment, market valuation, higher product innovation. But also, those firms appear to have high excess abnormal returns. But this says little about jobs, right? So the question we'd like to investigate is, what about the impact of the advent of AI on jobs? And the traditional approach to answer this question is the one of labor economists, such that Daron Acemoglu, who just received the Nobel Prize this year. And what they do is that they study the impact of automation AI at a macro level, I would say. And they observe very important key phenomena. First of all, job displacement. Automation replacing tasks previously done by humans. I think it's Emmanuel who was talking about AI agents. This is something we could definitely integrate in our paper, but for today I will only discuss about AI enhancing jobs, agents. We also have job polarization, so the hollowing out of middle performers, middle skill employers, sorry. Keeping only employed the low-skilled people and the high-skilled jobs. And we also have a wage pressure of AI, especially on unskilled workers, low-waged workers, and task reallocation. But there are some limits to this approach to labor economics. In particular, it says little about the impact of AI on interesting, important type of jobs, the one performed by skilled workers and for whom we need to provide incentives. So it doesn't have so many insights on how AI adoption may reshape the incentive structures of the contract, the job contracts themselves, and the firm-worker relationships. And that's what we want to investigate with Gilles in this paper. And to do so, we adopt a contract theory approach. So for those of you who may not know what is contract theory, it's studying the design of contracts when there are a misalignment between the objectives of the employer and the employee. And it's particularly relevant when there is an agency friction. So as I said, this can arise when you have a difference in objectives, but also when there are some information asymmetry that exists. For instance, the effort I'm putting at doing the task as an employee is not observable by the firm that employs me. And it appears that embedding this agency friction may be particularly relevant because it has been shown, for instance, that this type of friction, we call about moral hazard, the unobservability of the agent's effort at performing a task. It has been shown that it's one of the most important sources of financing constraint for private firms. And it's also particularly costly for firms. So there is this paper about from Eco and Lee that make a structural estimation at how costly is moral hazard. And they show that this friction is accounting for 50% of managerial compensation. So knowing now that AI is spreading fast, it may be interesting to understand how it will interact with the presence of such agency friction. And so here, with this theory, we'll be able to examine contractual relationship at a micro level instead of macro level, and to explore, as I just said, the interaction between AI and moral hazard. So the broad question we'll address is how AI adoption by firms may reshape the contractual arrangements. And to do so, we will design an optimal contract framework. But the kind of novelty here is that, so usually this kind of optimal contracting models are done in, not in general equilibrium. So it's where there is one firm, one agent, and at the end of the termination of the relationship, the firm goes bankrupt, liquidates the asset, and the worker just go fishing for the rest of his life. It's a little bit different. We have a competitive labor market where the termination of the contract, you will have the labor market forces that will derive the value for the agent and the firms. And in this, we will embed AI that can enhance the agent. So this is the basic version. We have a more advanced version where we also assume that AI can replace the agent. But here, for the sake of the timing, I will just discuss about agent augmentation or enhancement by the technology. And as usual, I would say in this class of model, we'll have to provide incentives that will be twofold. You have carrots and sticks. Carrots, where you get paid after the success of the project, and sticks, you get penalized, which is here you get your contract terminated after poor performance. And the novelty will be that we have some general equilibrium effects that will be appearing thanks to our settings. So broadly, the main results that I will present today will be conditions for firms to prefer AI, so prefer to adopt AI. So I won't spoil more myself. You will see there is a very nice graph at the end of this presentation. Basically, the idea is that it's a little bit like our students that are doing this investment and financial markets we are doing, the class we are giving to Master in Finance students, when we discuss about the optimal investment, we say to them that the expected gain of an investment is not a sufficient statistics because we need to account for the risks. It's a little bit the same thing. The expected additional gains from productivity gains from adopting AI is not sufficient. We also have to account for how it impacts the severity of the agency friction. And we also present conditions for the agents to benefit from AI in general equilibrium. And it will be mainly the case when the adoption of AI will make this financial friction more severe. So the agent will be able to extract more agency rent from the contractual relationship. What I mean by that is that when AI is purely productivity improving, so it only increases the productivity of the project, thanks to this general equilibrium, it's the firm that will capture all the gains from that. And it's quite intuitive because by terminating the contract, I will be able to offer a new contract to a new agent that will also benefit from the AI. So my contract I can filter out what is out of the scope of the agent. And this productivity gain coming from the adoption of AI is not coming directly from the agent effort. So I don't need necessarily to pay the agent for that, to reward the agent for that. So this is basically what will be presented here. So to give you an idea about the model, the timeline, we have a two-period model. At first, the principal offers a contract to an agent. The agent accepts or refuses the contract. Then he makes one effort. The payments are realized. And then there will be a second period where you do another effort and the output is realized. And this, we embed AI in this way. We assume that the principal may adopt or not AI at two interim stages, before the agent exerts the first effort and before the agent exerts the second effort. So at the two stages. And this may be particularly relevant for questions that have been addressed during this roundtable that I will keep away from my presentation today, but we are all pretty convinced, I think, that the quality of AI is evolving in time. So there are some conditions under which the principal may prefer not to adopt AI at the first stage and wait for AI to become better, to improve itself before adopted. So I will keep the model as simple as possible, and if there is any students in the research in finance master degree that are following my class, they will see it's exactly the same notation. So we have an agent that is exerting an effort, and then he takes the value 1 or no effort, and this is at each period, and the effort is associated with a cost incurred by the agent. And when the agent is enhanced by AI, one of the effects will be that it will affect the cost of effort for the agent. For instance, it will make the effort less costly. It's exactly what was presented by Tom from IFC. They can now reduce the cost of seeking for new clients. The agent will derive a certain intertemporal utility, and the project will produce output at the two periods. By exerting effort, it will increase the probability to reach the high output. And there is a second gain coming from the adoption of AI. It will also affect the productivity output of the firm, going from Q to beta Q. And I say a little about the value of alpha and beta for now. Of course, we all have in mind that alpha may be lower than 1, so the technology may decrease the cost of effort, and beta may be larger than 1, so increasing the productivity of the firm, but it's it's not that clear. We discussed about the cost of querying an AI prompt as an agent within the firm. Maybe it's increasing rather the cost associated to performing the tasks. So their alpha may be larger than 1 in this context. And so as I said, we are embedding a labor market with that, meaning that if you terminate the contract as a firm, or if you decide to quit the company as an employee, you may be able to find a new relationship that will provide you the value of entering into the contract in expectation, minus some search costs that are the kappa P for the principal, so the firm, and kappa A for the agent. It will become more clear in a minute. So here I'm presenting more what is the value of R, which is the value on the labor market for the agent. It's simply how much he expects to earn from a new relationship, minus the search cost. And one can solve for what are the optimal transfer he would receive from this new contract. And what is very interesting is to note that, so the transfer, I'm assuming some limited liability, so I got only 1 transfer when the project has been successful, but you see that U star bar is equal to a function of alpha, and beta is not appearing in the value of the transfer. So meaning that when alpha increases, meaning the agency friction is more severe, agents will be able to extract more money from the relationships, as we would expect. And because beta is not entering, it means that the productivity gains from adopting AI as a firm do not have to enter into the optimal payment. You do not need to pay the agent more because by implementing ChatGPT, it produces 30% more, for instance. And what is interesting is to note that it will depend, the value of the transfer will depend about the value of the search cost for agents to find a new relationship. It will be in this way. So this is the optimal transfer that firms may offer to agents. And from this, we can find the value on the market for the agent as a function of the search cost. Of course, when the search cost increases, the value on the labor market for agents decreases up to a certain point where they have no value, so they exceed the market, if you want. And we can do the same for the principal value, so for the firm's value on the market. Here again, we see that it's a decreasing function of the search cost for the firms to find a new match at interim stage. So this was about the value on the labor market. Now let me present you more in details the optimal long-term contract. The objective will be for the principal to find a way to implement high effort. And there is a particular point that is important, that plays a key role, is that the way to incentivize the agents at the final stage will display a memory property, so we won't forget about the past. If the agent performed poorly at first stage, then it will have an influence on the contract you design, on the consequences. It will have consequences on the second stage. And so there is a big challenge for solving this, is that the optimal contract must align incentives over time. And the outcomes are stochastics. And so to solve it, we'll solve it by background induction. Today I will mainly present the later stage, so what's going on at second stage of the relationship, and I will give you some insights on intuition on what's going on at the first stage. So again, we have to ensure that the agent wants to exert effort and gets more value from exerting effort than from shirking, so choosing not to exert effort. And this will give us a first constraint. And we will also have to ensure that the agent participates in the game. So wants to remain within the company, while he could get a value R that I presented a few slides before, by quitting the company and going back on the labor market. And so here again, by imposing limited liability, we can solve for the optimal contract and find the value of the payments provided by the firm at the final stage if the agent keeps being employed. And so this value will increase with alpha. Again, the more severe is the agency friction, the more the agent is capable of extracting some agency rent from the relationship. And if alpha is too low, so don't really take into account the values that are written here, but the magnitudes are correct. If alpha is too low, it may be better off for the agent to just quit the relationship. On the firm's side, what we observe is that, well, the more severe is the agency friction, the most costly will be the relation. So the firm's value will be decreasing with the severity of the agency friction, resulting in the implementation of AI. This was about how AI impacts the severity of the agency friction, but as I said, we assume that AI may also increase the productivity of the agent. And as you can see, I only presented the agent value as a function of alpha, not beta, because it's independent of beta, as I explained earlier. So any productivity gain will be captured by the firm, and it will be captured linearly. And so the last graph I wanted to present is, when is it optimal for firms to decide to adopt or not to adopt? And to answer the question, it's important to not only look at the productivity gain implied by the adoption of AI, that is represented here by the value beta. So of course, if your productivity is increasing by 20%, that will be the value beta equal 1.2. You would be better off, but it's only if it keeps the severity of the agency friction constant. If it increases too much the severity of the agency friction, then the costs implied by employing an agent enhanced by such an AI may not be profitable for the firm. What I say then is that for a given productivity enhancement, firms may delay the adoption. As I presented in the timeline, we assume that firms may decide to adopt before the first effort is exerted, and if they haven't adopted yet, they can wait and adopt at before the second effort. And this is something that is not represented here, but of course, we have in mind that the quality of the technology may increase over time, and you may have situations where it's better off to wait for the AI to be adopted. So to conclude briefly, we show that productivity gains alone are not sufficient. It's not a sufficient statistics to determine whether enhancing AI with agents, enhancing agents with AI, is optimal. Because it's also important to consider the changes in the severity of the agency friction that they will provoke. And for some jobs, this is a very important friction. Again, there is this paper by Nicolas Sterry and Schmidt that shows that this is the main friction for public firms when they employ agents. Then about our separated the gains, the marginal gains of adopting AI between firms and workers. Well, most of the time it will be firms that may capture all the benefits from adopting AI. Why? Because whenever AI will increase the productivity without affecting the severity of the agency friction, it's firms that will capture everything. And so the value on the labor market for agents will remain constant. Another situation is when AI increases the productivity of the relationship and decreases the severity of the agency friction. So what we can have in mind is a monitoring technology that makes it more difficult for the agent to hide his effort from the firm. So in this case, it will even decrease the rent. And the only situation where the agent may expect to benefit from the adoption of AI by the firm, here again, adopting AI is a firm's decision, is if it increases the misalignment between the firm's objective and the agent's objective. So an example is that it makes the agent able to use more sophisticated ways to underreport the cash flow, for example, of the company. This kind of situation. Thanks a lot for your attention.
Okay, thank you very much, Vincent, for this presentation. We have time for 1 or 2 questions. Yes, please. So just 1 second. We'll give you the mic.
Thanks a lot. So my point is about the following. You are mentioning, if I understood well, that most of the gains of AI would be captured by the firms. If I translate that to a practical use case, which is adopting a ChatGPT by a firm for, let's say, all employees, each employee will possibly gain, I don't know, 1 hour or 2 hours per week, which is big but not huge. And I don't really see how those gains would be directly captured by the company. I mean, if I have 1 more hour per week, I may as well do sport or watch TV or anything. And here the value is captured most exclusively by myself. I may also work more, which would be good for the company. But I'm not sure that the gain is solely captured by the company itself.
So it's an interesting question you are asking, is whether the advent of this kind of technologies will make people work less, in a sense, for the same output level. And this is a question that exists for decades and maybe even centuries. Tinbergen already in the 70s was asking these questions on the Nobel Prize for his works in labor economics. Here, of course, we assume that we don't really study this aspect. So I cannot say what would occur really much if we let the agent choose his level of effort. Here, it's only you work or you don't work. The quantity of works you put is something that is not really studied. But it's not clear with the competition on the labor market and the fact that there exists a continuum of agents able to do the same thing that you and that are all identical. It would be optimum for you to underwork in this situation. It's not clear, but I don't know the precise questions.
Tom,
yes, Tom
has a question.
Just to your last point, the willingness of the agent and the participation of the agent depends largely on the competitiveness in that particular market. And if you overlay that, what you've seen recently in the United States, you had this massive strike of the ports where you have a set of agents which have a tremendous amount of leverage compared to other industries, but the industry itself can largely benefit from massive automation and in handling of ports. So wondering what your view is on that one, the overlay of that particular market dynamics of the agents itself.
So it's also a very great point you are mentioning. And to be completely honest, I think that this is exactly the kind of questions where a labor economics approach may provide more insights than the contract theory approach. Because at our level, we are studying one-to-one relationship. Even if we put that in a general equilibrium setting to kind of have some labor market pressure entering into the design of the contract. But these macro level questions are better understood, in my opinion, by labor economics work.
Okay, thank you very much. I think it's my turn now to present a paper. So Vincent, you will have to time my presentation. Don't be too tough. Okay, hi again, everyone. So I'm going to present a joint work with my PhD student, Rémi Genet, entitled Enhancing Event Study Power with Machine Learning. I'm afraid that many of you do not know what are event studies, but it turns out that this is a technique that is widely used in finance when we try to quantify what is going to be the impact of some specific event on the price of a company. Okay, so let me just present you some examples. So for example, there are lots of event studies on mergers and acquisitions. So what we are trying to see here when we use this technique is whether we see some appreciation or depreciation in the price of one of the two companies, the bidder and the target, which could be related, for example, to synergies or stuff like that. We are also interested in analyzing what happens when there is a regulatory change. Because when there is a change in the law, this is potentially going to have a large impact on the profits of a company, and we would like to estimate how big the change is going to be related to this change in the regulatory and policy that govern the business. And it is also used in litigation. Suppose, for example, that there is some insider in the company who makes trades which are illegal normally because you don't have to trade the shares of your own company, and the guy is caught by, let's say, the Securities and Exchange Commission, and at some point we have to estimate what are the profits that have been made by this guy because this is going to determine the amount of the fine is going to pay. So the problem when we want to compute what is the impact of an event is that we are not in a lab-controlled environment, because the price of a stock is reacting to many different factors. So for example, there could be a merger that is announced, and this should normally result in an increase of the price of the target, but suppose that at the same time there are very bad news on employment, okay, so that the market goes down. So you don't know what is the part of the change in the price of the company that is related to the event, and the change in the price of the company that is related to other factors that are likely to have an influence on the price. And so this is the reason why there is a need for models that are going to be able to control for the various factors that are likely to influence the price of a company in order to be able to isolate the part of the change in the price that is really related to the event. And so the way this is done is by computing what we call abnormal returns. So what is the abnormal return? That is that occurs at. Let me see if this one works better. Yes. So what we call the abnormal return, well, this is the difference in the return, that is the change in price that you observe at the time of the event, and the price that you should have observed if the event had not taken place, okay? Which is a difficult exercise, because what should have been the price if the event had not taken place, okay? So this is the big difficult part, okay? Being able to compute the would-be price if the event had not taken place. So fortunately, there are smart guys in finance, and especially these ones, Gene Fama, who had the Nobel Prize, I think in part for developing this technology of event studies. And what they say is that you should be able, actually it is possible to compute the would-be return of the company using a famous model that has been developed by William Sharpe, another Nobel Prize winner, which has the following. It says basically that the return of a stock, I, on a given date t, is a linear function of the return of the whole market at the same time, okay? And so based on this, it is possible to compute the abnormal return by taking the difference between the actual return, the one you observe, and the one that is predicted by this model. Well, this model needs some parameters, alpha and beta, and these parameters are estimated on an estimation window, which is a period of time that takes place prior to the event. Okay, so here is how it works. So this is the good one. Okay, so here is how it works. So suppose that the event takes place at date 0. So there is a period which we call the estimation window, on which we are going to estimate the parameters of the model that allows to compute the normal return. Generally, there is a buffer period just to make sure that we estimate the parameters of the model on a period that is not affected or impacted by the event itself, because we don't want the parameters to be contaminated by the event. And then on this even window, we can compute the abnormal returns, okay? So how do we compute these alpha and beta parameters? This is simple statistics, and I think that most students in the audience know how to do this. We use ordinary least squares, so that's just a linear regression, okay? Well, it turns out that after the market model, some progress has been made in asset pricing, and so today we have richer models to capture the factors that are likely to influence the price of a stock, so we are better able normally to compute the would-be return, the normal return, and the state of the art before Semyon discovered something else is to use Fama-French 3-factor or Fama-French 5-factor model. Sorry, I don't have time to go into detail about what are these factors: small minus big, high minus low, robust minus weak, and conservative minus aggressive, okay? But these are good models, I think, believe me. So, the point is that computing this thing, that is the would-be return, the normal return, is typically a prediction exercise. So I explained that first this was done using the market model, which is something that is rooted in financial theory, because there is this model that we call the CAPM, the capital asset pricing model, that sort of justifies why you should have this linear relationship between the return of a stock and the return of the market. Regarding Fama and French, it's not that clear. It's a sort of hybrid between theory and something that is more data-driven, because basically these factors, they have been built after observing that there were some issues with the CAPM and some particular issues that these factors are supposed to fix. And so in this paper with Rémi, we take a fully data-driven approach, okay? And the idea is the following. We are going to use a cluster-based predictor to compute the would-be return at date 0. And the idea is the following. We are going to use all existing stocks that trade at the same time of stock I on the market to identify stocks that are very similar to I, thanks to a clustering technique, which will allow us to group similar stocks into similar groups. And this is what we are going to use to compute the would-be return. Okay, so how does it work? So we have our estimation window. So we want to compute the abnormal return for firm I, which means that we are first to compute the would-be return, the normal return for firm I. So we are going to identify all stocks other than I with contemporaneous return. And we are going to build K clusters. This number K will vary, you will see, and we will use different values for K from the non-I stocks using an algorithm which is called the K-means algorithm. And then what we are going to do is that we are going to match the returns of stock I with those of the firms that are in the cluster that is the closest to I based on Euclidean distance. Then we will compute the return of the portfolio made with all the stocks contained in the cluster that is the closest to I, and then we will run the regression as we would do with the market model, except that we will have more explanatory variables, and in particular, one of these explanatory variables will be the returns corresponding to the portfolio of stocks, which is the closest to firm I. And then after, we just compute the abnormal returns as we do by taking the difference between the observed return and the predicted return. And after, I will show you how we can check whether our procedure is better than a procedure that relies on the market model or a procedure that relies on Fama-French or Fama-French 3 or Fama-French 5 factors. It's difficult. Okay, so just to give you an idea, so suppose that we have 1,000 stocks trading at the same time as stock I. So what we do first, we divide these 1,000 stocks in, let's say, 10 clusters. Okay, K is set to 10, but as you will see, I will use other values for K. And then based on this, we find the cluster such that the returns of the stocks the returns of the portfolio made with the stocks in that cluster is as close as possible to the returns of stock I. Okay, and believe me, you can see that the fit is not that bad. Okay, I've taken only one example, but in general, it's not that bad. Okay, it does a pretty decent job when we try to be as close as possible as the returns of stock I. So the problem now is we have a new procedure to compute abnormal returns, but how can you know if this procedure is better than the existing procedures or not? And so to do this, you have to run a simulation exercise that have been devised by two guys in the 80s, Braun and Warner. So here is how it works. We want to see first whether when there is no abnormal return, our procedure is going to tell us that there is no abnormal return. Okay? So we want to make sure that our new way of computing abnormal returns is not going to generate false positives, if you will. Okay? And then we want to know whether when there is an event occurring, we are able to say that there is really something happening. Okay? So how can we do this? So we run this simulation exercise. So we did it with US data. So we build different portfolios. And in this exercise here, we build 1,000 different portfolios. And in these portfolios, we put 50 randomly chosen stocks. And for these stocks, there is an event date that is randomly chosen. Okay, so we built, everything is random in this. And so, since every stock is randomly selected and the event date is randomly selected, on average, we should find nothing. Okay, we shouldn't find any abnormal return. Okay, and so we will test that, and I will show you how we test this. And what we do next is we put artificial shocks at the time of the event. So what do? We increase or we decrease the return on that date by some amount, which is -5%, -2%, -1%, -5%, and the same in the positive territory, to see whether we are able to detect that something is going on when we put this shock on the return. Okay. So first, a table to show you how this works. Okay. So you remember that I can consider different possible numbers of clusters when building the model. So we considered 5 clusters to 50 clusters, okay? So depending on the number of clusters you use, you will have more or less stocks in the cluster that is going to be matched with the stock whose abnormal return you want to compute. And of course, the more clusters you create, the less you are going to have a high number of stocks in the cluster. So in the extreme case, it can be only 3 or 1 stock in a cluster, but you can see that on average, it's around 900 stocks when you have 5 clusters, down to 361 stocks when you build 50 clusters. So this is a test to check whether the method we propose is better than the existing methods. So the idea here is to look at the residual correlation across the stocks in the portfolio. The idea being that if you are better able to compute the would-be return, then you should observe less residual correlation across the stocks because you are more able to explain what should be the return of the stocks. Okay, if there is more correlation, basically this means that there are still some factors that you are not capturing that are explaining the returns of the stocks. And so I think that the result is not that bad, because if you use the market model, remember that this was the standard until FAMA French 3 and 5, you have a residual correlation of 2.39%. It drops down to 0.6%, 0.6% with FAMA French 3 and FAMA French 5. But if you use clusters, very quickly, with only 5 clusters, it goes down to 0.5%. And it can go down, if you combine clusters and FAMA French, to 0.23%. So this means that we are more able to capture what are the determinants of the returns, and so to better compute the would-be return, the normal return, than traditional models. So the next step is to see whether our approach is better than the existing ones or not. So remember, we build 1,000 portfolios at random, okay? So since everything is random, on average, we shouldn't find any abnormal return on the event date, right? But this is on average. Actually, what happens is that the return of a portfolio has some probability distribution, okay? So basically, you are going to conclude that a portfolio displays some abnormal return if its actual abnormal return is 2 standard deviations away from 0, basically. Okay, that's a standard hypothesis test. And so you do this for each of the portfolios, and there are 1,000 of them. And so if your test is correctly specified, and if you decide that an abnormal return is significant at the 5% level, that is the return of the portfolio is 2 standard deviations away from 0, to consider that that portfolio exhibits some abnormal return, then you should see that across the 1,000 portfolios you have, there should be 50 of them that display significantly different from 0 abnormal returns. Well, actually, this is not exactly 50 out of 1,000, because again, you are making simulations, so there is some randomness, so there is some distribution behind the exact proportion of portfolios you are going to find which are such that the abnormal return is different from 0. And actually, it can be shown that if the percentage you get is between 3.6% and 6.4%, your test is correctly specified, which means that you are not generating false positives. You are not erroneously concluding that something is going on when nothing is happening. Okay. The next step is to look at the power of your test. So when there is some artificial shock that is created by introducing some extra return, either positive or negative at the time of the event, are you able to detect this shock? Okay? And so you can see that the clustering method we propose is more powerful than the existing methods. So here again, you have to run some test. It's called the Markner-Morse test to see whether the percentage you find is statistically different from the percentage you find if you use another method. But what we find is that our method is more powerful by 4% for, I would say, little shocks of the order of -1% or +1%, or very, very small shocks of the order of negative 0.5% or positive +5%. In every case, our method is better able to identify that something abnormal is going on these stocks. Of course, if the shock is very large, if it's a very large price movement, any method is going to be able to detect that something is going on. So here I put the results for what is called no event-induced variance, which is basically the simplest case that can occur. And it's pretty much the same in a more complex framework where we have event-induced variance. And what happens in that case, so for very small shocks, it's very difficult to detect whether this shock is normal or not, whatever the model you consider. But you can see that the clustered method we propose is better able to detect large shocks in that case than traditional models by an amount which is sometimes close to 6%. Okay, we are 6% better at. There is a 6% probability. No, we increase by 6% the probability that we are able to detect that a shock has taken place, that there is some abnormal price movement on a stock. Okay, so that's the conclusion. So we try to propose a different methodology to compute the abnormal return of a stock. We use a cluster-based approach, sometimes clusters only, sometimes combined with Fama French 3 and Fama French 5. And what we see is that we are able to generate better prediction of what the normal return should be. And based on this, we are better able to quantify what is the abnormal return of a stock at the time of an event. So far, as you can see, we have tried different number of cluster values. We are not sure at this point whether we should use 40 clusters or 45 clusters. We are trying to fine-tune all this, but I think that there is some potential in this new technique. Okay, thank you very much for your attention. So if you have questions, I can take them if we have time left.
Hello, everyone. Thank you for the interesting analysis on the event prediction. I was wondering whether you had time to look into the Magnificent Seven and the US stock market, because they have been leading the markets, and to what extent these have been abnormal or not.
Well, be careful, because what I mean by abnormal here is the way you react to some event, actually. So what I want to quantify is when something is going on, when something happens, when some event occur, what is the magnitude of your reaction? Okay, so there must be some triggering event we are interested in, and really the objective is to see whether the price is somehow reacting to the event. So this is the reason why I had this example on, for example, litigation studies, because you know that something is going on. You have a CEO, for example, who is selling shares of the company at a time when the market is not informed that there is something bad for the company, and you want to estimate the profit he made from the fact that he had advanced information about the state of the company, and this is what we want to quantify. So we need something, some event. It's not just is NVIDIA too expensive today, for example. Okay, it's a different perspective.
Yeah, the type of events you're looking into is some idiosyncratic.
Yes, exactly.
Specific
exactly.
Events, or it's
exactly.
Yes. Okay.
Yes. It's not necessarily just stock specific, because this is an event that can hit simultaneously several companies at the same time. Okay, like a change in the regulation, but there must be something happening that is likely to cause a change in the price of the stock.
Thank you very much.
And we want to capture the magnitude of that change.
Hello. I very much like your method. So it seems this is very much dependent on the time window that you're using. And also you mentioned you're using this clustering method, KNN, sorry. But
K-means,
yeah,
not KNN, not nearest neighbors.
Yeah, sorry, yeah, the K-means. But my question would be, I mean, this type of clustering methods are in this specific case, it's not dynamic. So you're establishing this number of clusters. Here, 40 or between 40 and 15, you have that gap.
We go from 5 to 50, but I only displayed the results for...
Okay. Yeah, on the other table you showed some more clusters. How are you thinking about making this an adaptive modeling? I mean, for the future, because I guess these have already been backtested.
Regarding your question about whether it's dynamic or not, so I forgot to mention that when we run the simulations, we take stocks from the CRISP database going from 1973 to 2023. Okay, so it's a large sample period, and so we pick some random date, and we consider that some stock are going to be exposed to an event. Those stocks are randomly selected. We are going to be exposed to that event that takes place at a randomly chosen date. I'm not sure that this would be interesting to put some dynamics in this, because the point is that I'm not trying to predict what is going to be tomorrow's price, for example, okay? I'm just trying to see whether, knowing what is for example, the state of the market now, what should be the return of the stock now, okay? So I'm not trying to predict what is going to be the price in the future. I'm just trying to see what should be the price, okay, given the state of the market. Okay, so I think that putting dynamics into this is not necessarily useful. And for example, we tried to add to the model the momentum factor, thinking that potentially this could be interesting, and it turns out that it adds more noise than it solves issues, right? So you had a question? Oh. Yes, they are, because we build the clusters first, because first we are trying to see what are the stocks that are the most similar to the stock whose abnormal return we want to compute. You run a regression. So basically, it's like doing the market model or doing FAMA in French, but here we are going to add a vector of returns on the estimation period that corresponds to the vector of returns of the cluster. Okay, so there is a regression step in computing the parameters, and we need them to be able to estimate the normal return on the event period. That's the big question, of course. But we try to make sure that what the results say here, basically, is that we are not that bad. Because if the parameters were so bad, we would have too many, for example, false positives, or we would have a specification that is too low, and we wouldn't be able to conclude that there is some shock occurring when there is a shock. So I think that the parameters are not that bad.
Thank you. Really interesting, even if I don't get everything. But I have a question, is when this kind of model can be used as a tool, and who is the main user for this? Will be the AMF or some asset management firm?
I know at least one user in this room. Well, this is used for, yes, typically this can be used by the AMF, okay? Because suppose that someone manipulates the market, okay? And first you have to prove that the price is manipulated. So this means that you observe patterns or returns that are not in line with what should be expected. And once you have this proof that something wrong is going on, you have to be able to establish the amount of the manipulation to be able, after, to penalize this guy consistently. That is, you will get a fine that is proportional to the profits he made. So you have to be able to estimate these profits.
Thank you.
Okay. So I think it's time to have a coffee break before listening to the keynote by Semyon. Thank you very much for your attention. So please take a seat. So good evening, everyone. I am very pleased to introduce Professor Semyon Malamud, a renowned expert and thought leader in finance. Semyon is an associate professor at the Swiss Finance Institute at the Ecole Polytechnique Fédérale de Lausanne and a research fellow at the Center for Economic Policy Research. Additionally, he serves as an associate editor for some of the most prestigious international journals in economics and finance, including the Journal of Finance. So Semyon's research spans a broad spectrum of topics encompassing asset pricing, market dynamics, agent behavior, portfolio management, risk modeling, and the role of financial institutions. His groundbreaking contributions have been published in the top-tier academic journals. And in recent years, Professor Malamud has been at the forefront of an exciting research program exploring the applications of machine learning in finance. His work delves into how these cutting-edge technologies can revolutionize asset pricing and portfolio management, providing both theoretical insights and practical applications. And so tonight, he is with us to share his expertise on these transformative areas in his keynote address entitled The Virtue of Complexity. Semyon, very many thanks for being with us today, and the floor is yours for a 1-hour presentation, so I will show you sheets of paper to let you know what is the remaining time if needed. Thank you very much.
Thank you, Fabrice, for inviting me, for a very kind introduction. It's a great pleasure to be here. I think you told me last time that this is the place where JFK gave a talk, so it's very nice. That's what I told my friends and family. So I'm going to talk in the room where JFK used to talk.
Now it's working.
1, 2, okay, yes. Okay, yeah, so the title of the talk is The Virtue of Complexity. This is a part, sort of a description of a big agenda that we are pushing with Brian Kelly, who is also very famous for his work on machine learning, and many co-authors, most of whom are our former students or current students. And so what I'm going to start with is this very important principle, which is called the principle of parsimony, which human beings really like using when they build explanatory, sometimes causal models of the world, right? I mean, so in fact, if you think about how humans come up with stories or explanations, many of those examples you can see by reading, I know, Financial Times, the Wall Street Journal, you will see that people always come up with stories that are simple. There's always like, they will maybe find 2, 3 major driving sort of forces that they use to explain stuff that has happened before. And this principle of parsimony, which seems to be sort of hard-coded into our minds, probably on a biological level, it also has found its place in many textbooks that some of you have read probably. And I'm going to just state one of those. It's sort of textbook rule number 1 in economics, which says that in practice, it's important that we employ the smallest possible number of parameters for adequate representation. So this idea of parsimony, you can find it in many philosophical books. Probably you heard about Occam's razor. So William Occam, he was a famous British philosopher at the time when Britain was still a leader in sort of scientific research. And so the principle of parsimony seems to clash with the massive parameterizations adopted by modern machine learning algorithms. You've heard about it. Some of the panelists today, they mentioned these very big numbers, like billions of parameters, etc. So GPT-3 had like 175 billion parameters, and GPT-4, nobody knows how many parameters it has, but rumors say it's more than 1 trillion, and if you Google says 1.76 trillion parameters. It's a big number. Okay, and so this is sort of, if you hear it, and if you yourself have tried to build statistical models ever, or any kind of data set that you worked with, it kind of feels weird, right? I mean, you will think that, how can this even work? How can you build models? It's as if, think about it like this, it's as if you try to write an article in Financial Times where somebody would ask you, so what happened yesterday in the market? And instead of coming up with 1, 2, or maybe 3 stories, you would describe 1.7 trillion stories in your Financial Times articles. So obviously that would be kind of infeasible and, well, just in space, because you can't write such a long article. It's happening sort of everywhere in machine learning. For example, leading image recognition models seem to exhibit tremendous complexity in the number of parameters. They also have like tens of billions of parameters, and those big models are really powerful. Okay, and so in particular, if you take our best models today that can really well recognize images, I don't know, let's say you want to recognize individual humans in a big crowd of humans. This is we have powerful software that can do it now. It's important in the surveillance technologies. I'm sure French government has one of those. Chinese government has one of the best in the world. And it turns out that these models are extremely, extremely complex. Now, you could ask the question, well, you could build a complex model, but maybe in the end, there's some kind of simple core to this model. Maybe you could reduce somehow the core of this model to a few major things that matter. Okay. And it turns out that the answer is no. For many of these models, reducing them to a smaller size is difficult. You can do it a little bit, but in many cases, it seems non-trivial. And so one beautiful example I put here is in the red, distinguishing cats from dogs defies the principle of parsimony. So what happens is that if you look deeper into the structure of these best, let's say, image recognition models, you can mathematically try to count how many independent features does the model construct to solve its sort of classification problem. Right? So imagine again, like using this example of cats and dogs, so you have an image of an animal. Let's say your data set only consists of images of cats and dogs, and you'd like to figure out whether this is a cat or a dog. So normally it is believed that humans solve this problem. We seem to be quite good at distinguishing cats from dogs, right, in the street. It happened to me maybe only 2 times in my life where I was not able to exactly know if it was a cat or a dog. But most of the time, we solve this problem with almost 100% accuracy. And it is believed that we do it in our minds by constructing features. So you look at the shape of the ears and the tail and you know, stuff like that. And it is also believed that humans do it by constructing a few very salient features, very powerful, obviously visible features that we can detect easily. But that's not how machines do it. If you look sort of mathematically into the structure of these models that recognize images, you will discover that instead of finding a few very large salient features, they construct thousands of very small kind of features that know, like the shape of individual position, geometrical position of individual hair on the back of the animal to decide if this is a cat or a dog. And this is really interesting, right? And because it raises sort of fundamental questions, and what about humans? Do we do something like that? And it seems there's a bit of evidence. Now here, there's a speculative that there are only a few articles that sort of provide some evidence that humans also doing the same. So you see that's sort of on here, you see are humans different. The evidence is that human beings do the same, that human beings also construct many, many, many features that they use to make decisions. So that's very important because we don't really understand how human mind works, and we know that this emulation of human minds, like large language models, they do something that resembles humans in some ways. And the big question is, do they use complexity or not? Or do humans use complexity or not? So that's a very interesting question I like thinking about. Okay. And now in finance, there's also now growing evidence that something like that happens. For example, there is this influential paper by Brian Kelly and co-authors, about 4 years old, who show that if you build a very big neural network with many parameters, then it can predict the stock market better than simple models. Okay? And so econometrically, from the point of view of a classical sort of econometrician who has received classical training like myself, okay, it feels impossible. It should lead to disastrous overfit, right? Because you just trying to fit too many parameters to too few observations, and but it seems to be incorrect, right? So image and NLP models, NLP is natural language processing, so large language models with astronomical parameterizations, they often exactly fit the training data, and that they still work out of sample. Okay, and so a lot of our logic about sort of how big the models should be that we build to explain physical reality around us are based on this basic statistical wisdom about overfitting. So it's a beautiful picture from a classical textbook on statistics or machine learning, written by 3 remarkable scientists. At least 2 of them are Stanford professors, like world famous. Trevor Hasty has more than 100,000 citations on Google Scholar. He's a very, very famous researcher. And so this is a picture from this book that shows you the classical logic. So when you increase model complexity, when you add more and more parameters to your model, what will happen is that on the training sample, on the sample on which you train your model, your error will go down. Obviously, if you have billions of parameters, you can explain everything, right? That happened in the past. But then out of sample, so in the future, the red line here, eventually as the model complexity increases, the performance of your model will drop, or the in here, you see the prediction error, it will increase. And so usually you're looking for this sweet spot. You see this red curve somewhere in the middle, that is sweet spot where the prediction error is minimal. That's sort of the optimal amount of complexity that you should use. However, this is not what's happening in the real data. So this discovery was made about roughly 10 years ago when people working in the industry and building neural networks to do image recognition and whatever you name it, they discovered that they were using the gigantic models, and when they build bigger models, those models work better. Okay? So when you look at this picture, what is this picture about? So ResNet is a particular neural network architecture that uses, it's a very big, complicated neural network, has a lot of parameters, and so you can increase the number of parameters of this neural net, and that's what the horizontal axis is doing. And then you could look at the training error and test error. So the green, this green sort of dashed line, this is the the train error. So this is the error for your model to explain the data on which it's been trained, okay? And the test error is the purple line. And so you see this vertical red dashed line, whatever is happening before is called the classical regime. And let me remind you, that's exactly what you see on my previous slide, right? I mean, this picture where the training is monotone decreasing, and the test first decreases and then increases, right? And that's exactly what you see here. However, what you see, there is this sort of, in physics jargon, you could call it a phase transition. There's this threshold beyond which the behavior changes. And your test error, so the error when you go out of sample, it first decreases, then increases, and then decreases again. Because it decreases 2 times, this phenomenon has become famous under the name double descent, because the descent happens 2 times. And even more interestingly, you see that this double descent, the level of error that it achieves in this modern regime, okay, is strictly smaller and sometimes significantly smaller than the minimal error that the model can achieve in this classical regime. You see this purple line goes way lower than its minimum in this sort of this U shape in the classical region. So that was an important discovery, and I wanted I was thinking how to better organize this presentation. I wanted to do a little bit of fun, a little bit of history, sort of to put it into perspective of how this knowledge has been evolving over the last few years. So I put here, so this is the picture that you just saw. It's from this paper. It's called Deep Double Descent. So you all now know what double descent is about. And why did I put the front page of this paper on the slide? Is because of this person here. So this guy here, Ilya Sutskever, he's a very famous computer scientist. Some of you might have heard his name. He has been a lot in the news. And if you Google him, there will be lots of fun pictures and stories about him. He's kind of a genius. And the reason why he's become so famous, well, look at his affiliation, OpenAI. Okay, but he's not just some kind of employee of OpenAI. He was actually a co-founder of OpenAI together with Sam Altman. So this is the first picture that Google gave me when I asked, give me a funny picture of Ilya Sutskever. So that's the funny picture. So this is Sam Altman. You probably all know him, right? He's sort of the big boss of OpenAI. And I don't know if you heard, but there's this story that he carries with him this blue backpack, which has this sort of killer button where he can kill ChatGPT if ChatGPT tries to take over the world. Anyway, he's kind of a public figure, definitely smart and interesting, whatever, but yeah. So, and many people believe that he will eventually create artificial general intelligence. But so Ilya was sort of the technical mind behind OpenAI, and in a way, because of that paper that I just showed you, so they were thinking that the big models are better, right? And so OpenAI, when they discovered this, they started experimenting, and then they wrote this very famous, influential paper, which is called Scaling Laws for Neural Language Models. Okay? So you can see now the affiliations look different on this paper. Every single author is from OpenAI. And so they were kind of the first people to discover the scaling laws. Some of the panelists today, they mentioned scaling. What are scaling laws? It's basically like the pictures that you saw before. So they plot test error, right? So whatever test loss is, think about it as the prediction error as a function of various measures of the model size, okay? So here, the computer, I'm going to skip this one. Let's focus on these two. So what you see here is that the bigger the data set size on which you train the model, the smaller is the error. So that's kind of not surprising, very intuitive. It also holds for humans. You know that the more you train a particular human, usually, not always, but usually the particular human will work better out of sample, right? I mean, now, professors have experience with students, and they know that for some students, unfortunately, this monotone curve is not present. But for many good students, it is present. Right? The more you give the data to students, the more you train them, the better they perform out of sample. So that's this curve here. Right? About your student is your large language model. The more interesting and surprising curve is this one, so parameters. Okay, so this is the number of parameters of your model, and you see that the model is monotonically improving performance. You can see that here they went to about 1 billion parameters, and they saw that this was just getting better and better. And at the time when this was created, it was believed that then you should build models with 1 trillion, 10 trillion parameters, and that this curve will continue like this, and eventually we will create artificial general intelligence. Today, people don't believe this anymore for various reasons that I won't have time to cover in a 1-hour presentation. But what's important is that the general principle, bigger models do better, is there. The technical question is whether the saturation happened, and that's sort of right. At some moment, it just flattens, basically. Okay? But the fact that big models do so well, and that in principle, building bigger models allows you to achieve better performance out of sample, is just so striking, so surprising, so counterintuitive for most human beings I have interacted with. Okay, I don't know about all human beings, but those I discussed this topic with usually found it surprising. Okay. And so what I'm claiming here is that it's also happening in finance. We're trying to build a case for financial machine learning, and we wrote this paper with Brian Kelly and his PhD student, Kanyin Zhou, where our main theoretical result is sort of a theoretical proof of this double descent picture that you saw, or if you want, the scaling law picture, right? I mean that as you increase the number of parameters, the performance of financial machine learning models improves, okay? And we also tested this empirically. I'm going to discuss in a few minutes why perhaps it's even more surprising that it works with financial data than the fact that it works with, I don't know, human language. So this is a picture from our paper where you see what we're plotting here is the Sharpe ratio. So those of you who have some finance background, you know the Sharpe ratio is sort of how we measure quality of a trading strategy. It's sort of it's a quotient, how much return you get per unit of risk. Okay, and so the higher your Sharpe ratio, the better you are. And so what you see here is that as you increase the size of the model, out of sample Sharpe ratio, so you can look at this black curve. This is your double descent, but sort of inverted. You see that the model performance first increases, then decreases, and then increases again. And the interesting thing is that consistent with that picture that I showed you from the OpenAI folks, the performance in this modern regime is better, significantly better, right? Much higher Sharpe ratio than the best performance you can achieve in this low complexity classical regime. Okay? So now, this plot here that you saw was sort of for a prediction problem, where you're trying to predict the future, and sort of the implication is that under some technical conditions, you should build really big predictive models that utilize like big neural networks. There's a lot of parameters, and the more parameters you put there, the better will be the performance out of sample. We called it the virtue of complexity, because complexity becomes a virtue. Okay? The more complex the model, the better it performs. There is a similar kind of mirror image of this in the theory of asset pricing. So those of you who don't know what asset pricing is about, so think about financial market, stock market, right? Every single company out there which is publicly traded, it has a stock. That stock has a price. Let's say in the United States, we have about 5,000 publicly traded companies. In Europe, it's a smaller market, maybe 1,000. Okay, but it's still a big number. Okay, so think about that at European stock exchanges, we have about 1,000 different companies traded. Some of these companies will have a high price. Some of these companies will have a low price. And asset pricing tries to understand why. Okay, so asset pricing attempts to answer the question, why is it that some companies have a high stock price and some have low stock price? And so you try to build statistical and theoretical models that explain this. And that is what's called asset pricing. And one fundamental asset pricing theory that underlies many of the theoretical developments, in particular Fabrice mentioned it in his presentation, is this thing called APT, arbitrage pricing theory, which is based on this idea of principle of parsimony. Remember, principle of parsimony is sort of biologically hard-coded in our minds, and so academics have this unbearable desire to build parsimonious models, even if they don't fit reality. And APT is one of those models, okay? And so what we sort of introduced, we call AIPT. This is just sort of a game of words, just artificial intelligence pricing model, but the game here is that there's only one letter difference. And what we show is that basically instead of building a small number of factors that explain these thousands of stock prices, you should build much more, maybe thousands of factors, maybe even more factors than the actual number of stocks. Okay, and then those models explain data better. Okay. And so we have a theoretical result where we prove it, and then we have direct empirical support for the theory where the numbers we get are really interesting, kind of completely consistent with the theory. And one interesting thing I wanted to mention for those of you who like mathematics, or maybe don't yet know if you like mathematics, but considering the possibility of liking mathematics, is that we use this specific tool called random matrix theory. Okay? So random matrix theory is basically a particular area of math or statistics, if you will, that attempts to describe behavior of complicated systems in high dimensions. Okay, so remember, think about every parameter as being a dimension in your model, right? And so if you want many parameters, you need a high dimensional vector of those parameters, and so you need this special statistical theory to deal with it. Okay. And so random matrix theory is really powerful tool. Physicists use it. People have got Nobel Prizes for using it to explain behavior of various physical systems. And one beautiful thing that it comes with is a phenomenon, largely mathematical phenomenon, which is called universality. Universality is something that many physicists are obsessed with, and economists now as well a bit. I'm for sure obsessed with universality. And basically what happens is that in certain systems, the behavior of these systems, when they are in high dimensions, they are independent of the actual structure of the data. Think about it like this. I don't know. Most humans are very different, right? But in certain particular scenario, most humans will behave in the same way. Okay? Think about this as a manifestation of universality. And this universality can be found in many aspects of the physical reality in which we happen to live. And one beautiful example that you might remember from your statistics class is the central limit theorem. So maybe you remember that this very special probability distribution called a Gaussian distribution or normal distribution, it looks like this, like a bell. It's a bell shape, right? I mean, and it turns out that in many, many scenarios in the world, if you look how stuff is distributed, it will follow this bell curve. And this kind of striking, it was discovered by a German mathematician, Carl Friedrich Gauss. That's why it's called Gaussian, about 200 years ago. And it was striking to him. When he saw it, he said that it's remarkable because it's as if this sort of universal principle about how stuff sort of is distributed is encoded in this physical reality. Okay? And there are many other laws like that. And in particular, random matrix theory, it comes with some of these laws. Let me show you I'm going to show you a manifestation of this universality in a minute, but before we go there, so let me show you what this sort of virtue of complexity looks like in this world of asset pricing. So think about here, I'm plotting the Sharpe ratio, but you could think about the Sharpe ratio as sort of a measure of quality of the model. And again, this now is purely empirical curve, and again, you see here is that so this model has been fit on the United States stock market. So think about 4,000 publicly traded stocks, okay? And here is basically the number of factors that we use to explain this data, okay? And the larger these curves, the better is the explanatory power of the model, okay? And so Fabrice, in his presentation, he was advocating a model that uses 3 factors, okay? And then he mentioned maybe you could use 4, but the 4th factor was not good. So the model with 4 factors will be somewhere here, okay? And so you could the performance of this model is 0.5, maybe 0.6, okay? And if you build bigger models, you can get all the way to 4. So about a factor of 10, okay? So that's kind of surprising because, again, it violates this principle of parsimony. The more interesting thing is that the shape of these curves exactly matches what the theory predicts. And this is this manifestation of this universality, okay? So there are certain, what it tells you, that there are certain patterns in the data that are universal. It doesn't matter how the data is structured. It will always produce this sort of curves, including this double descent curve, or double ascent in this particular case, because it's inverted, goes up, down, and up again. And so, but here is another even more sort of beautiful manifestation of this universality. And let me tell you what I'm showing here. So, those of you who have worked with multidimensional data, you've worked with so-called linear regression, you might know that a key object when you do linear regression or you do multidimensional statistical analysis is this thing called covariance matrix. So this is going to be a matrix, symmetric square matrix whose dimension equals to the dimension of your data. Okay. And what the statisticians, econometricians often do is they look at the eigenvalue distributions of this matrix. Okay? And now, of course, those of you who have worked with data, you know that if data is generated in a simulation from a very clean, simple structure, the actual covariance matrix that you will obtain will depend on the particular realization of your simulation, because there will be randomness involved. You know, we'll generate a bunch of random numbers, and the eigenvalues of this matrix will also be influenced by this randomness. And so, suppose I tell you, okay, let me consider 2 data sets. One data set respects the principle of parsimony, meaning there are just very few factors that actually impact the data, and the rest is kind of useless. This would be the world in which Fabrice's presentation lives. Let me consider another world where every single factor matters equally. Okay, so this will be a world where there are hundreds, if not thousands, of different factors. Let me simulate data from these 2 models, but in a situation where I don't have enough observations in order to decide what's happening. So in this particular case, I have 360 observations, okay? And I'm considering a model that has, I don't know, let's say 10,000 different factors. In Fabrice's world, only 3 of those factors matter. The rest is useless noise. In my world, all of them matter. Okay? And you look at the eigenvalue distribution of the covariance matrix that you have simulated, and it turns out that, this is the blue one is actually the true empirical distribution that we get in our numerical experiment. And the purple line here is, in fact, 2 lines. The red line and the purple, but they exactly overlap. So what happens is basically these universality laws of this random matrix theory, they predict that, in fact, in these high dimensions, the 2 matrices will have exactly identical eigenvalue distribution. So that means that by looking at the data, you will not be able to decide whether I am in the world of Fabrice with few factors that matter, or I'm in this world IPT where thousands of factors matter. And this is kind of striking, okay? So you can show that these phenomena are universal. That's why they call it universality. And they really impact the way we think about the world. And in a way, once I started working on this and we discovered this phenomena in different parts of the data, then we started proving theorems about this. And I started thinking that everything I do in my life is 90% dominated by this complexity issue. Because as a human being, every day I need to make causal inferences. I need to decide about causalities between actions that I take or people around me take and the consequences of those actions. And because I have so few observations, so little data to make those decisions, I'm constantly facing the situations where there might be thousands of different confounding factors determining whether actually what I did mattered or not, whether it affected the outcome positively or not. And so I have to do this. I have to live in this world where I have very few data points and a lot of factors that actually impact the outcome, okay? So everything we do is sort of impacted by these universal laws. And what will happen now, if you ask a lot, what does it mean for our understanding of the world? Well, imagine a world populated by biological entities that we call humans. And these humans making decisions based on very few observations in a high-dimensional setting, right? I mean, you go out, I don't know, you try to predict whether it will rain today, right? I mean, and you do this based on a few observations. And for me personally, I know that the accuracy of my rain prediction model is very bad. And so is it for the Google app that I use on my phone. But it's like everywhere, okay? So it turns out that because there are these universal patterns in the statistical learning that these entities will exhibit when they have these very few observations, this will then impact the function of the whole economy, everything. Financial markets, everything will be impacted by this. And that's a really interesting sort of way to think about the world. Okay. And so then, over the last 20 years, what we have discovered, right, is that these large, heavily parameterized neural nets, they work kind of everywhere. Okay, they work in image recognition, they work in natural language understanding, translation generation, games, protein folding, discovery of new materials, proving mathematical theorems, finance. I'm just, is this surprising, right? I mean, somehow many people, or at least many people who I spoke to, and that's actually a relatively small sample. It's again a small sample bias, remember? We don't have enough observations to make sort of generic conclusions, but those people that I with and who can tolerate talking science with me, many of them find this not surprising. Okay, we found a bunch of neural nets, we have these big computers, but actually it is absolutely mind-boggling surprising. Okay, and you know that this year there were 2 Nobel Prizes awarded for this sort of neural net stuff. One of them was in biology or chemistry, and another one was in physics. And does it deserve? So I think the answer is definitely yes. And the reason is that, in fact, the fact that we can learn such complicated things about the world with so few observations, it is remarkable, okay? In fact, you can do a very simple simulation exercise, something that I teach in my class always. You can pick a random nonlinear function, okay? Just to pick any nonlinear function that comes to your mind, build a simple machine learning model, and then try to see how many data points you would need to actually, the model to learn this true function. And then the answer is, in many cases, you need astronomical numbers of points. And in particular, this is true in the physical world, where many functions that describe physical reality, they have this thing, maybe some of you have heard this is fractals, okay? So many functions, they have this fractal structure, they're very kind of non-smooth, irregular, and so they're very difficult to learn, okay? And so the fact that we have discovered that actually we can learn a lot about the world, about human language being probably the most complex object out there that we have successfully, I don't know, cracked with neural nets, it means that we have discovered hidden structure in the world around us, and it can be learned due to the virtue of complexity. And this is striking. In my personal opinion, this is probably the biggest discovery of mankind since quantum mechanics in the beginning of 20th century. Quantum mechanics, of course, general relativity is even bigger, but it was before, right? So Yeah, so this is a simulation exercise that I encourage you to try, right? So pick a nonlinear function, pick a bunch of, call it bases, but basically think about these features. Remember I told you about cats and dogs, so think about big features that you would try to use to learn it, and try to learn, you know, without noise, okay? And the answer, what will happen in many of the simulations is that you will not be able to learn it. Your out-of-sample error will be infinite if you want, okay? And this kind of striking because it touches a lot of interesting questions which to some extent are even philosophical. Those of you who work with financial markets and financial data might have heard this general idea that financial markets have very low signal-to-noise ratio. So whatever information we have about financial markets, there's a lot of noise around it and very little informative in the information. And so that's why it's so difficult to make money, right? So we had here several people today that were quite successful making money with financial markets, but they still always complain, right, that the predictive power of their signals is small. This is really different from the cats and dogs examples where the signal-to-noise ratio is kind of infinite, right? There's no noise. You look at the picture, you know it's a cat or a dog. And but it's very likely that our view of the world is incomplete, that our inability to predict the stuff that's going to happen in the future is not because of noise, but because of this complexity, that the fact that these functions that describe reality are just so nonlinear, so complicated, we just don't have enough data to learn them. But it might be that there is no noise, that there is, yeah, like here. Okay. Now, when you talk to people about using machine learning in finance, many of them will, you know, object because people like objecting new stuff, right? I mean, this is sort of, again, probably hard-coded in our brains. And so people will say, well, the world is changing, and so you can't learn any kind of nonlinear relationship, even if it's there, because every day is different, and we have new technologies, and everything's changing, political structures, etc. And so that's why we should go for simplicity, right? And this sort of non-stationarity thinking about the economical systems is one other motivation for why people say, let's go for simplicity. I'm going to argue that this is wrong, okay? And you should instead go for over-parameterized models because they learn universal patterns that persist over time, okay? And I'm going to show you a very interesting, simple experiment that actually you could do yourself with like data that you could get for free. There's this whatever API called Yahoo Finance. You can literally download the data and just run this experiment. So here's what I did here, okay? So I took a bunch of stocks. Here I took like largest, I don't know, 500 stocks in the US economy. And I tried to build the following very simple trading strategy, okay? It is called momentum. Those of you who have some finance knowledge, maybe you've heard about it, but it's really a trivial strategy. What does the strategy do? It buys stocks that went up recently, and it sells stocks that recently went down. Okay, so you could say, wow, really, this is so simple, and you can make money with that. The answer is, yes, you can, and many people have made billions with this really simple trading strategy. It's called momentum. And so here are some different incarnations of the strategy, and you see that it actually, this trivial strategy used to work amazingly well until like 1999, and that's when many people became rich, but it sort of stopped working. You see now it's sort of flat, okay? And so what I'm gonna do now is the following. I'm gonna take this signal. So think about this as being a prediction problem, okay? So I have a lot of stocks. I have past return on the stocks. I see that the stock went up or down over the last month. I see whether the stock went up or down over the last 3 months and 6 months. And I take these as features. Remember, like looking at cats and dogs and the shape of their ears, I'm looking at stocks and the shape of their returns. And I'm going to feed this into a very simple nonlinear model. Okay, I'm going to build this model, remember, so that it has a lot of parameters. And I'm going to train this model over this period. So you could argue, this is a very special, very different period. We had a Vietnam War there, we had the collapse of the Soviet Union, a bunch of interesting stuff happened, invention, lots of new technologies, etc. Okay, so this is a very specific 30-year period. You could argue, or at least most people would argue, that the 30 years after, which is sort of where most of my life happened, 1994 to today, they were kind of very different from 30 years, right? A lot has changed in the world. However, it turns out that the model that was trained on those 30 years works equally well in the last 30 years. Okay? So what does it mean? So it means that there are some kind of really simple, fundamental, nonlinear patterns in the way stock prices move over time. Those patterns were there in the 60s and the 70s and the 80s and the 90s. And they are so powerful, so strong that the model can learn them like that for free. It's really a trivial model that I built. And the same patterns work today. They worked here, and they even worked after COVID, because many people could think that COVID was a big shock, and many things has changed, right? So this is sort of a beautiful illustration that this non-stationarity argument is probably wrong. There's plenty of stationary, non-linear things happening in financial markets that just persist over time, and they were there in the 60s and 70s. You could ask me, what is it? It's probably about humans, right? Probably about how humans make decisions, how humans behave, because our brains haven't changed much over the last few thousand years. So for sure, they haven't changed much over the last 60 years or so. Okay, so what this means is that we are kind of witnessing the birth of a new inductive bias. Okay, so inductive bias is a philosophical term. It's a set of assumptions that a learning algorithm uses to make predictions or generalize beyond the given training data. So all of us have inductive biases. Many of them are subconscious. Humans have a lot of inductive biases that are built into our minds when we are born, okay? And the above findings suggest that we should reconsider the inductive bias known as the principle of parsimony, and so new inductive bias is that complex models seem the better, or maybe not just stock market, but just explain any kind of data better. And then we need to understand three fundamental questions. There are other questions that we need to understand, but among them I highlighted the three. The first one is, what do complex statistical models actually learn? The second one, why do they work so well? And the third one is, what happens in equilibrium if agents use complex models? The third one is probably the most interesting for those of you who are interested in economics. We saw some very beautiful presentation about equilibrium, right? So equilibrium is this idea in economics that when agents, make decisions and change the way they behave, then the markets will also respond, and the agents have to take this into account, right? And this creates lots of sort of interesting, self-exciting kind of phenomena. Okay, and so I'm gonna give you a couple of insights about what could lie behind these three questions. The first one is, what do complex statistical models learn? Okay, and here I'm going to mention one of my favorite metaphors, which is the so-called Plato's cave. So Plato was a Greek philosopher. He lived on this planet about more than 2,000 years ago, or maybe 2,500 or something. And he had this very interesting idea that humans can't really perceive the true nature of reality. He had this, why it's called a cave, because he had this metaphor that the humans are like chained to the floor of a cave. They can't see the true nature of things, but they only see shadows of the things on the walls of the cave. Okay, and then by looking at shadows, they try to figure out what is the true nature of things. And this was generated by ChatGPT. By the way, I asked him, show me a nice picture related to this idea of Plato's cave. And so what you see here is that this is the true object, but imagine somebody who can't see the true object, but he can look at a particular wall of this room, not a cave anymore. And you'll see that if you look at this wall, it looks like this, and if you look at this wall, it looks different. And so what happens, this is now a mathematical theorem. You can prove that when you try to train a model that has more parameters than observations, or just a very large number of parameters, like ChatGPT, for example, it can't really learn the truth. It can't learn this true nonlinear function that describes the data. Think about, in the example of ChatGPT, think about the existence of a function that describes the structure of human language. I strongly believe that such a function exists. And ChatGPT has learned a lot of stuff about it, but not the full function. That's why it keeps hallucinating, etc. And so what happens is you can prove that instead of learning the true function, it learns the projection of this function onto a wall. Unfortunately, I can't go into details what mathematically it means, but mathematically it means that there's like a subspace or a manifold on which this function gets projected. Okay? And depending on which machine learning model you build a different wall. You can build this wall or this wall, and then it will give you different results. Okay? And so in a way, what the progress that we've been seeing is that we've been building different walls in this cave because we can't really learn the true nature of the true nonlinear functions that describe reality because we don't have enough data. And what we're trying to do now in our research is we're trying to understand something about the functions that explain financial markets, okay? By projecting them on these different walls, and that's why every time, if some of you work on machine learning, every time you build a new machine learning model, for example, Remy sitting there, he built a beautiful machine learning model he presented on his beautiful poster today. So that's like he built one more wall in this cave. He will never, neither he nor me nor anybody else will ever be able to learn the true nature of these nonlinearities. But every new wall tells you something different about this true object. Okay, and that's very interesting. The question is, the next question is, why do they work so well? Okay, and this phenomenon in machine learning is known as alignment. So alignment is basically about the idea that when you use a particular machine learning model, nonlinear model, to explain the data, it will only work if that model is aligned with the true structure of the data. Think about your true object being, I don't know, my finger. If you try to project it on this plane, you'll get a, you will lose this. But if you project it like this, right, then you will actually see, oh yeah, that's a finger. So in the first example, it was not aligned. In the second example, the wall in the Plato's cave was aligned with the object, and so I can see its structure. So for some mysterious reason, the models that we've been building over the last 2 decades to explain human language, images, etc., they just happen to be aligned, and I wrote mysteriously here because I do find this mysterious, with the true nature of the data. Okay? So every time you do it, you can sort of measure this alignment and to understand, you can, for example, measure how much information has been lost, etc. Okay, and that's extremely interesting. Thank you for this. Okay. And then once you start thinking about this alignment, you understand that, of course, if you have a 3-dimensional body and you project it on a wall, a lot of information is lost, right? I mean, so there are pieces of information that are just cannot be recovered. And if you think about the true nature, true nonlinearity described in the whole financial markets, think about 5,000 stocks or something, is so nonlinear, so high-dimensional that no matter how many times you project it on different walls, still a lot will be lost. Can you measure how? Okay. And so here, we introduced this quantity that we call complexity vector. And think about it. So imagine that your objective is to make money, and how do you do it? You build a portfolio trading strategy. You build a portfolio, and if your portfolio is good, you'll make a lot of money, and if it's bad, you will make a little money. And so if you build imagine there is an ideal portfolio, and this ideal portfolio will really make you a lot of money with little risk. Okay? This PF is the abbreviation for portfolio, and here you will see this IS, this is in sample, and OOS is out of sample. Okay? And so what will happen then, of course, if you build a gigantic portfolio with a lot of parameters, then your in-sample portfolio performance will be very good. Remember the training loss, right? The training loss will be small, or the performance, which is like inversely related to the loss, will be very good. Okay? And that's what you see here, is that this bar is very high. And why? Because it has this component that we call overfit. You overfit the data. What will, however, happen is that out of sample portfolio performance will be much less. In particular, if you look at the height of this bar, so this is the ideal portfolio performance, but your portfolio performance will be smaller because of this gap. And this gap here, we call it limits to learning. And this limits to learning, again, is related to this Plato's cave and this projection property, is sort of how much information is lost when you try to learn this complicated nonlinear model. Okay? And so now we are developing a sequence of papers. We are developing sort of theory on how to quantify this, how to quantify this limits to learn, how to quantify this complexity wedges, etc. And once this is done, you will be able to figure out how much sort of your model has been overfit, how much information you're still losing, etc. In particular, we will be able to answer the following question. This is sort of my obsession. It's going to take a few years of work. How predictable is actually our world? So you may know that in the classical paradigm of, let's say, Newtonian physics, the world is entirely predictable, right? I mean, so everything is determined by initial conditions. Now, quantum physics came, and it's not clear whether the world is predictable at macroscopic scales, etc. But in principle, you could use this mathematics to answer this question, okay? So you could take all the data in the world, and you could fit it through a machine learning model, and you'll build a model that can't really predict well. But you could, if you could measure this wedge, okay, you could measure to what extent the world is actually predictable. Okay, that's something I've been working for a few years now, but it's going to take a while. Okay, and then finally, remember the last question: what happens in equilibrium if agents use complex models? The answer is weird things. Unfortunately, I can't tell you more at this stage, but let me explain you why things can go sort of wildly wrong. So if you start, the classical economic paradigm assumes that economic agents are Bayesian. So maybe you know there is this bias rule. So usually we think that economic agents, they start with a prior. This is sort of how you think about which things matter and which things do not. And then as you observe more and more data, you update your prior. This is the so-called Bayesian learning. And usually this is how we model rationality of economic agents. Okay? And it turns out that if you carefully look at what OpenAI is doing and image recognition models are doing, etc., they are kind of close relatives of this Bayesian learning. Although they're not exactly Bayesian, but in the essence, they have a lot of sort of Bayesian flavor. And the problem is that normally, when you think about a Bayesian agent, the prior with which the Bayesian agent starts learning doesn't really matter much, because even if you start with a really stupid prior, like you start with, I wanted to make a joke about Donald Trump, but decided not to do it. But you start with a, I don't know, you start with a prior that a particular human being is smart, but then you observe his actions and then you update your prior, right? And usually we think that, you know, eventually your prior will converge to, you know, to the truth. Okay, so if somebody is stupid and you start with the prior that this human being is smart, after observing a few actions, your prior will converge, right? If you learn rationally. The problem, however, is that if you're in a high-dimensional setting where you're trying to learn many, many parameters, let's say you're trying to figure out which things matter for monetary policy and which do not, then learning is extremely slow. And it turns out that there are sort of universal patterns in the way this Bayesian learning evolves over time. And what will happen is that instead of converging to the truth, you can prove mathematically that Bayesian learning actually tends to diverge. And this, I believe personally, is what underlies, for example, all the weird societal patterns that we observe in modern world. For example, we know that societies now in many countries are getting polarized. It's even happening in Switzerland, which is kind of striking because I'm from Switzerland and we kind of believe that our society is relatively homogeneous, but it's not the case anymore. There's huge political polarizations with lots of things. And I believe that this is happening because we are getting access to such high-dimensional information that our Bayesian learning just diverges. Yeah, and that's sort of an example of this divergence. Oh, is it? Thank you, Fabrice. Okay, so now I understand I'm probably almost out of time, right? And so how much time do I have? 7 minutes. Okay. So let me show you now a bit of sort of concrete stuff, underlying some of the pictures that you show. I'm going to show you how we actually construct these trading strategies that is sort of so much better. Remember, there was this curve, and I told you that what Fabrice presented was this point on the curve where the complexity is small. So how do I build this model? It's going to have a lot of finance jargon in it, but it will also give lots of interesting insights about, in general, how do you think about machine learning, etc. Okay. So the way we build trading strategies in finance is as follows. So imagine you have a bunch of stocks. Okay, I'm going to use index I here to index those stocks. I'm going to assume that we have n stocks here. N could be a large number. Remember, I mentioned like 1,000 or 2,000. And those are going to be the returns on those stocks, the percentage profit that you make if you buy that stock. If return is positive, you make money. If it's negative, you lose money. And these guys here, I'm going to call them characteristics. So for every stock, we have a bunch of features. Like for cats and dogs, we have features like shapes of ears. For stocks, we also have features. Some of these features are trivial to build, like I told you, like past return over the last month or a year. Some of these features are more tricky to build. For example, you could compute the value of the book. So you could compute the total value of all the assets that the company owns, or how much money it's making in selling its goods, etc. Okay? So you can put all these here. Those are going to be features. You're going to multiply stocks with these features and then sum across stocks. These quantities here are called characteristics managed portfolios. Okay? And then you can do the following. So you can take these very simple characteristics. Like in my example, those would be stock returns over a month or a year, or this book ratios, or sales, or how much debt a given company has. Everything that sort of should matter for the way the company operates, okay? And then you can apply to these basic, simple characteristics nonlinear transformations. This is so actually how a lot of machine learning models work, okay? So you apply this, and I'm going to call this nonlinear feature number j for stock number I. And this object here is called an embedding. So what's happening is I start with a relatively low dimensional vector of characteristics. So this d number here could be small, could be 100 maybe. Some companies that professionally trade stocks for, for profit, they would maybe have access to a couple of hundred of such characteristics. So this little d here would be maybe 200. But then once you got those, you can build many, many, many nonlinear transformations of them. Okay, and that's going to be my P. And P, in principle, can be unbounded. I can make it thousands, tens of thousands, as big as I wish. Okay. And this idea of transforming relatively low-dimensional input data into many, many nonlinear features is what underlies neural networks. So if you look at this picture here, you will recognize that this is basically a very simple rudimentary neural net with just one hidden layer. Okay, it takes input data, just d-dimensional, it builds many, many, many features here, right? So each dark blue circle here represents a different nonlinear feature. Okay? And so then the big question is, how do you pick those features? And the answer is nobody knows. And before we go into discussing this, I really wanted to make this beautiful reference. So basically, there is this theorem in mathematical logic, which is called the ugly duckling theorem. And it says that classification is not really possible without some sort of a bias. Okay? So what classification are we talking about? Well, in specific to financial markets, right? You're trying, as an investor, for example, you're trying to solve the classification problem. You want to know which stocks are good, those you want to buy, which stocks are bad, those you want to sell, right? So it's a very simple binary classification problem. As an investor, you will ask yourself, so which feature should I use to decide if a particular stock is good or bad? And the answer is there's no general answer to this question. And in fact, there can't be any answer because of the ugly duckling theorem. And so here's a beautiful example. Let's suppose that one is to list the attributes that plums and lawnmowers. So think about plums as being the good stocks and then lawnmowers being the bad stocks. And so which features do they have in common? Both weigh less than 10,000 kilograms. Both did not exist 10 million years ago. Both cannot hear well. Both can be dropped. Both take up space and so on. Likewise, the list of difference could be infinite. And you can see, of course, as a human, you look at this, you think it's ridiculous. Why would you use these weird features to classify whether a given entity is a plum or a lawnmower? And the answer is that, well, for those, indeed, we have evolution, right? So kind of a few billion of years of evolution for our bodies and minds that tell us how to solve simple classification problems in the entities we observe in the physical reality. But for stocks, we don't have this. If I give you a particular two stocks and I show you some features, you won't be able to decide which features matter and which do not, which features are good and which features are not good. And therefore, instead of thinking about it, I'm going to do what I did here. I'm going to pick completely random features that I have no idea whether they actually matter or not, and I'm going to drop them on my stocks. Okay? And that's what I'm going to do here. Let me show you. So, how do I build this random feature? So I'm going to take my stock characteristics. Remember, like 100-dimensional vector. That stuff that's sort of supposed to matter. And then I'm going to build many, many nonlinear features, just like I did for plums and lawnmowers, okay? Completely random features. How do I do it? I generate a bunch of random numbers or random vectors. I multiply my meaningful features with these random vectors, then apply a nonlinear transformation. Here, you can see it's a sine function, but there's nothing special about sine. You can prove that sort of it's irrelevant. Any reasonable nonlinearity will do. Okay? And so I'm going to build many, many of these features. Most of them will be completely useless. Some of them will be useful. I don't know exactly which ones. And then I'm going to build my simple statistical model where I take these features and I try to use them sort of to predict the stock market. Okay? And then basically this, the picture that you saw, this is the picture that you saw a few minutes ago. It shows you precisely the result of this experiment. Everything here is out of sample. So remember, I sort of train my model based on, I don't know, first 30 years and then test it only based on the last 30 years of data, okay? So I built many, many of these nonlinear features, and as I increase the number of these features, the out-of-sample performance of the model increases, okay? So this is kind of striking, particularly because of stationarity considerations, and also because many of these features are kind of useless. And that means that somehow this feature generation is really aligned. Remember the alignment I mentioned, right? It's somehow aligned with the true nonlinear structure of the data. Okay? Well, I guess I'm out of time. 1 minute, okay, yeah. So let me go to conclusion. Okay, so asset pricing and asset management is the midst of boom of machine learning research. ML is abbreviation for machine learning, and we provide new rigorous theoretical insight into the behavior of machine learning models. Contrary to conventional wisdom, higher complexity improves model performance, and so we advocate this principle, virtue of complexity. The performance of machine learning portfolios can be improved by pushing model parameterization far beyond the number of training observations. Okay.
Thank you very much. We have time for some questions. Yes, please.
Oh, yeah. Well, first of all, I would like to tell you that I very much liked your presentation. I get that what you're saying is that you're talking about the topology of the data and the topology of the models that you have, and being able to select, say, the features that are going to be chosen as, say, the important features that are going to describe the dynamics of your topology in the future. So what you're doing, in fact, is this dimensionality reduction process by being able to discard the information that is not relevant to the majority of the signals that you're using. So my question is, are you working on any type of this like adaptive dimension reduction? Because I mean the effectiveness of the high dimension model is well, lies there in its high dimensionality. And when you reduce the dimension, you're losing information, just almost by definition. So are you working on any type of dynamic dimensionality reduction that preserves the topology of your data?
First of all, we're not doing any dimensionality reduction, right? Instead, we kind of, in some sense, expand the dimension, right? So we take, like in this particular empirical experiment, our input data has 130 dimensions, and we kind of expand the dimension to tens of thousands of different features. Now, there is, however, an interesting, so remember the Plato's cave example, and the idea that, in fact, even if you build thousands of features with limited amount of data, when you train the model, it will invisibly, secretly, without telling you about it, still project your data on some kind of low-dimensional space. It's out of your control in a way. So every machine learning model that human beings have invented so far does it. I don't know if it's possible to build other models. Maybe there are other alien civilizations who have different ways, but we as biological species haven't come up yet with an algorithm to do it. Now, the interesting thing is that, so basically the model that I built these thousands of these sine weird nonlinear functions, okay? And then I train my model. You can prove mathematically that what will happen is that it will project, it will do dimensionality reduction. It will project my data on some weird low-dimensional manifold. The problem is that I know that this manifold exists, but I don't know what it looks like. I don't know how to learn its structure. And the reason is basically what's called the curse of dimensionality. I know that this manifold lives in this 130-dimensional space, but to learn it, I need astronomical numbers of observations. So it's a super important, super deep question. I guess the answer is we are trying to do it, trying to understand the structure of this manifold, but we don't have much progress.
Yeah, well, this is just a comment. I'm talking about dimensionality reduction because, I mean, the methods that I have seen use this manifold approximation. So they kind of go hand in hand, but, well, it was just a comment.
Okay, thank you. Other questions? Yes, go ahead.
Thank you very much for your presentation. I have a question about neural network. As a new learner, I would like to know your viewpoint about neural network with just one hidden layer, because I think all continuous functions, any continuous functions could be represented by this kind of neural network. So what's the benefits to have more than one hidden layer according to you, and especially in a representation of financial markets?
Thank you. This is a great question. So remember, so in a way, I'm a big fan of universal approximation theorems, but in certain sense, they're kind of useless. In the sense that they have the capacity, like the family of functions that I use, which is a bunch of sine transformations with coefficients, is a one hidden layer neural network. And it has the capacity to approximate very complex nonlinearities. That's the universal approximation theorem. But the most important question is not that. The most important question is, given the limited amount of data, what kind of functions can I approximate efficiently given that limited amount of data? The universal approximation theorem, in the statistical sense, is telling me if you have infinite amounts of data, then you can approximate any function, because you need to learn those coefficients. And you know they exist. That's the universal approximation theorem. But to learn them, you need to apply a statistical methodology. And statistical theorems imply that actually one hidden layer neural networks are very slow learners. It takes astronomical amounts of observations for them to learn. For example, under some technical conditions, if your data input dimension is 130, so here 130 in the experiment I'm doing, then the number of observations that the neural net would need to actually, when you train it, right? Because you start with a neural net, which has some coefficients that are randomly generated, and then you train. So for this training algorithm to learn sufficiently good approximation to the truth, you would need to give it a number of observations which is on the order of e to the power 130, e to the dimension. E to the power 130 is a very big number. It's more than the number of atoms in the universe. So technically, we can't even build a computer that would be able to store this data. So what happens, however, is that as you build deeper networks, they can discover so-called hierarchical structures in the data, and they can learn faster. So any kind of family of neural networks, be it one hidden layer, two hidden layer, five hidden layer, transformers, these are the architectures that they use to describe large language models, convolutional neural networks. They're all, in certain sense, they're all universal approximators. The power of these architectures comes in their ability to learn quickly, meaning with relatively small numbers of observations. And that is where sort of, so think about it like this. Let me give you a cool example. Imagine that you live, I don't know, in ancient Greece. And you know the function x and x squared. Maybe let's start, you know only function x. And you discover periodical oscillation. Okay, you discover a sine wave. You discover it empirically. So you observe there's something that's going up and you say, oh, it's linear. So you approximate it with a linear function. Then it goes down, right? Over time you observe and you say, oh, it's quadratic. But then it turns again. If you don't know the cubic function, you're in a bit trouble. And then maybe Pythagoras or some other ancient genius Greek comes and discovers x to the power 3. And now you can fit this pattern. But then it keeps going up and down, and you keep coming up with different approximations. Suppose you've learned polynomials. So you will keep learning those polynomials and approximating your function, but it will be an extremely inefficient and slow process until you have discovered the sine function. I actually don't know who discovered it, but once you've discovered it, you'll get a perfect fit to your data. So in a way, your sine function is a perfect fit. Polynomial functions have the universal approximation capacity. They can approximate any function, right? The difference is that with sine, you learn it with two observations. You just feed it, and that's, you're done. But with polynomials, you will need thousands and thousands of observations until you got a good approximation to your data, right? So in a way, the revolutions that we see in machine learning have happened because smart engineers working for Google, Microsoft, OpenAI, you name it, have discovered families of universal approximators that learn fast. And whether they learn fast is defined by whether the particular family is aligned with the data. So if initially they try whatever multi-layer perceptron or one hidden layer, it's a universal approximator. In principle, it can learn the structure of human language. But it would take so much data that we probably don't have. So they were looking, can I find another universal approximator that's so well aligned with the structure of human language that it can learn it fast with just a few observations, few being hundreds of billions, whatever, tokens. And then they discovered it. So in a way, this data-driven process of discovery is about humans discovering classes of functions that are universal approximators that can quickly adopt to data. And for every particular type of data science problem, this family will be different. So that's sort of what data scientists do, right? They try, they say, oh, let me take this neural network architecture, or it doesn't work. What it means, it's not aligned with the data. It's still a universal approximator, but it's not aligned. It's likely that somewhere we will discover a new family of functions that is aligned with financial markets. The person who discovers it will become very rich, right? So far, we probably have.
Okay, thank you very much for this fascinating presentation and answers to the questions. Thanks again, Semyon, for your keynote address. Also, I would like to thank all of you in the audience for participating. I would like to thank all the organizers of the Dauphine Digital Days, and also my colleagues, Serge, who moderated the roundtable, and Vincent, who did the presentation of his article. So thank you very much. And the next session will take place at 6, I think, and will be about je sais plus. ce que les entreprises veulent et ce que les étudiants attendent, quelque chose comme ça. Voilà. En français, c'est plus facile. Merci beaucoup.